Hey folks, good evening. Welcome to another space with me, Kalu Aja. Of course, on our money space, we're talking money, the economy, and finance. And we're trying to make all those topics easy for you to understand, follow, become a better investor, of course, a better taxpayer and all. All right, so today we are talking, this is quarter three. September is going to be the end of quarter three. We want to review the quarter, review the economy, then talk about investing, but we're going to do investing this time with maybe with taxes in mind. We're going to ask an expert in that field how we can build a tax efficient portfolio, right? How can we do that? So, how can we using the new tax laws? How can we build something that would sort of like enable us to still invest, still get those dividends, but sort of reduce or avoid our taxable income? So that's going to be a good should we say, data point for most of us here that want to still invest and want to still be a good citizen, but don't want to pay that excessive taxes. So, without further ado, let me introduce my guest. Ayo, you can just unmute and you can introduce yourself so that we get to know you, sir. Welcome.
Okay. Good evening, sir. And thanks for the good job you are doing. Always learn from your post, and it's a great privilege to be here. My name is Dr. Ayode, and I'm an investment professional. Um, I have passion for financial education, and that's why always anytime Mr. Kalu Aja calls me, I'm always happy to be here. Thank you.
Thank you, sir. I do appreciate you joining us, sir, and also coming to teach us all these topics. So let's get right into it, sir. Lots of folks are here. Let's start with just if you can review the economy just for us, top down. How do you see the Nigerian economy so far? Have you been impressed? Do you think there are things we could have done better? Is it smooth sailing? What do you see? Green shoots? What? Talk to us, sir.
Okay, thank you very much. So, if we look at, so this is like 3 months, and if we want to first look at how on a comparison basis, so that's how we'll be able to appreciate it. So, the last 2 years or almost three have been very bumpy, right? It's like we're almost at a negative. So, if you look at like those graphs, if you look at the axis on the y-axis, that you have negative in terms of how the economy has performed. So we're almost say that is already down. There's no fall.
Yeah.
So look at most of the from the exchange rates. We look at inflation. We look at GDP. Would agree that the economy was almost at a negative point. So looking at coming to this year, so what we will start with the GDP. So we've seen the last 2 quarters an average of about 3%, which is positive when you look at the most of the sectors within that space. Yes, why agri is slowing down on the back of the insecurity is very significant, though maybe the news is not there. But when you speak with people on the field, there's still a lot of insecurity going on. So that continues to impact the agricultural sector. Services have been the major booster, and that has continued to boost the economy. You also look at the industrial sector. You also been doing well. You know, there's one common denominating factor in Nigeria, which is the FX. So the stability that we have enjoyed. So after the introduction of the BMAT last year, we would see that we have continued to gain in terms of the stability within the FX environment. So we look at the data even from last year on a year-on-year basis, you would discover that there's been appreciation about 10% compared to the appreciation that we have been having in the last 2 years on an annual basis in double digits. When you also check the parallel market and the official market, the gap is narrowed, which reduces speculation. So, and one thing that allows business to grow is the ability to plan. So what we have seen is that because you can project and you are seeing it also materialize, because it's one thing to project, it's one thing to do your analysis. It's to see that at the end of the year. So if you look at January, you are projected, let's say it's 1,600 naira, or even one. By now, you should see that you are recording again, because we've also seen that impact on the non-financial services company on Nigerian Stock Exchange. So you see the likes of MTN, they're already clawing back to the gains. You see the likes of Netflix, see Nigerian breweries, all those. So the FX losses that dragged them last year, now they're enjoying that gain. But beyond even the appreciation, the availability. So speculation have reduced. The FX is largely available, because this period, based on even my own personal projection, where there's demand for school fees, for us to be having an appreciation in the naira, it says a lot. Second, if you do a further analysis into utilization, in the last 3-4 years, average utilization for FX fuel demand is about 30-40%, has been estimated. Without refinery that you don't need to import. The importers are now even somehow forced to go to Dangote to buy, which means that they will not, with the naira for swap arrangement, they won't need to demand FX, and that is also helping to stabilize the FX environment. We now have inflation, which has been rebased. So when we look at the rebased inflation rate, the last one as at August at 20.4%. So you'd see that already that is also moderating consistently in the last 3-4 months on the rebased. But when you look at the month-on-month, that's still high, especially for food inflation. When I look at the data, when you see likes of with the slogan, the food basket of the nation, recording the highest inflation rates, highest inflation rate, you see the abnormality that should be the one to enjoy less inflation. It says a lot. That means that apart from the infrastructural challenges, so that's on its own, inflation still may high. You see, that's why we see the Monetary Policy Committee, which the meeting's coming up from tomorrow and Tuesday. They are not very quick to cut rates to react, because they need to also establish a trend. And they are saying that on a month-to-month basis, it's not been stable. It's not like moderating, because what they would do is they analyze it. What would have happened if it sustained this level? This is still high. But with what we are seeing in interest rate environment, stability in the FX, we think that maybe there may be a mild cut, because even if they don't cut, interest rate environment has also moderated significantly. The last yield has dropped from high of almost 27% yield this year to about 20.8%. That's it. You can see that margin. So overall, we'll say yes, economy is stable. Outlook, when you look at PMI data, business survey, 6-month projection, looks very stable on the back of FX. So it looks promising. But the main thing now is that how will this be sustained? Because that's what will also be the mind of everyone.
That's
will
true.
This be sustained? Right. Yeah, so I think I would just like to maybe pause here and maybe with your follow-up questions, touch on
let's go back to the dollar exchange rate. So the dollar has been weakened in the last month or so. The US tariffs, the rising yields, the refusal of the Fed or refusal to cut rates. So dollar has weakened. Let's put that in one corner. Also, the Nigerian oil sales have not really improved, right? We haven't really gone beyond that 1.5, 1.6, 1.7 OPEC quota and all that. And the bulk of our forex comes from oil. The dollar is weak. There's a chart I saw on the CBN report. It stops in April, but that chart is talking about the inflow of dollars into Nigeria, and it's talking about the inflow has come from foreign portfolio investment, which is bonds. So if you marry all three together, sir, it does look as if there's dollars in the economy. And that's why we see, like you said, the pressure has gone down and the naira has appreciated because there's dollars flowing in the economy. But the cost of that dollars is now what is being borne in the CBN. The question I'm asking is this stability, this supply of dollar, is it cost that the dollar has fallen and we are borrowing to fund it? Or is it more organic in that we're having remittances and that we're selling? What do you think is that? And then where do you see any flags in this two scenarios?
Okay, thank you very much. So the first thing that we can notice that speculation has reduced significantly. Then it's always been estimated that you have 30 to 40%. Everybody has to get naira, you are changing it to dollar. With the appreciation and people losing funds by buying dollars, maybe you bought at 1.8, 1.7, and it's now 5. People are also reducing the accumulation of dollars. And that has reduced the demand. Secondly, petroleum products. There's the demand that also come. So when you look at that, even if we estimate that, okay, 20% was speculation to be conservative, 20% was for petroleum products, you would also see, and for those that have their new investments, they are now balancing it. So if you know that you can earn 20% treasury bills, do you expect the naira to depreciate by 20%? So you may convert 50% of your earnings to naira and earn 20%. Buy the dollar, maybe earn maybe 6%. So you try to normalize and do a weighted average of your return. So that is reducing the demand. Secondly, that transparency is key. Like you always put market-driven environment. So with that demand, because when I speak with treasurers in the bank, that you see the rates. It's like you bought First Bank, you see the timestamp. So you can't say you bought a share above a certain range within the day. People will ask you questions because you can see the high and low. So all those anomalies are reduced. So people don't need to buy ahead because you are not sure if you are buying now, you may be losing indirectly at the end of the day. So all those things cumulate into the appreciation we're seeing. But that doesn't mean I would say this is short term, because the long-term sustainability is our ability to diversify our FX revenue. So, like you rightly said, if crude oil prices, something happens, then our crude oil prices decline significantly, and production also reduced, because it's still one major source. There will be pressure. People will start speculating. The foreign guys would also take a pause. You see, the FDI has reduced significantly. It means there's still no confidence to bring in long-term monies. Most of the foreign investors are just taking advantage of the OMO bills. OMO bills still delivers around 25-26% yield. So they are taking advantage of that, because they are apart from banks, foreign investors are allowed to invest in OMO bills. So that CBN is using that to at least generate the cash flow, the needed cash flow to create a bit of stability, which means it's at a cost to the CBN, because in 4 years, you would have paid double of what you have borrowed using OMO. So those are the things that we will need to look at while we're enjoying the gains now, because we're imports driven in Nigeria. So any major depreciation has impact on almost everything, because we hardly produce anything. So even if prices are always sticky downwards, so most suppliers, except when there's stiff competition, will not drop their prices, but at least will not increase it at the rate at which we were seeing before. So that would help generate a bit of stability, reduce the continued pressure on disposable income. But in the long term, that's diversifying our oil, our FX earnings is really critical to sustainability. You look at the agri sector, rather than just exporting raw materials, how can we add value to them that we begin to, how can we create blueprints that we can begin to earn other revenues? Because apart from remittances that CBN speak to remittances, all those can easily fluctuate if there's any major shock in global economy.
And that to me, like I said, is a red flag that I'm seeing, that the FDI, the foreign direct investments, are longer term, have collapsed, but the foreign portfolio investment, which are short term, has gone up. So the stability we're seeing, like you've seen, is a very, very short term, very, very, should we say, it can move. So we've got to take advantage now that we have this money in to diversify revenue sources so that we don't get caught up. Should there be a recession or oil prices go down, we'll now be exposed. Point taken, sir. Let's go to inflation. So like you said, the inflation numbers are down. The inflation was rebased. As you know, food used to be 51%. Now food is about 40% of the consumer price index. And we still have the insecurity in the food basket, like you mentioned, and all that. The inflation, in my view, has come down because we're importing food. So that, again, is that also a primer to why the CBN is very reluctant to cut rate, because it's also saying, though prices have come down, this is not an organic increase in supply, but more or less an imported inflation that we want to keep rates where they are and watch what's going on. Again, what's your in-depth analysis of that?
Yeah, so I think you rightly captured it, that the CBN is being careful to try to establish a trend in the inflation rates. So at 20.12%, still, if we want to compare to last year, so we would say, that rebasing maybe saved us like about maybe 8 to 10% based on the rebasing. But we've continued to see that if you look at it from the January that was rebased, continue to see that decline.
Okay.
But we also now look at it on a month-on-month basis. For August, for instance, yes, that's really moderated. But if you check before July, June, the month-on-month were growing. So which means that when we look at it economically, short-term, there's still short-term shock. So when you look at month-on-month, if it's growing, it means that short-term shock. For long-term, inflation is moderating. So CBN will still be very careful. Secondly, CBN would also want to consolidate more on the gains of these effects, because it's really, if in terms of rating, is added significantly to their scoring, if we put it that. And if interest rate falls to a certain level, now people are able to compare 20% fixed income Naira rate, and you look at the potential of what you get. If you can get maybe 9%, 10% in that, depending on the volume in dollars. If you think that the Naira will depreciate by another 10%, you will begin to buy dollars again. Even if it's by 8%, you begin to buy dollars again. So CBN is trying to keep that interest rate high. It is attractive enough that when you want to make that opportunity cost, or you want to make that option, you will see that the amount, what you would lose by taking one option, you will see that it is significant. So it will now become a risk return gain. That's you see. So by and large, I think that the inflation, the direction at which the inflation rate is going, is part of what is slowing down the CBN from making decisions. Food inflation, for instance, has continued to grow, which this says a lot that there's insecurity. If you listen to the news in the last few months, the insecurity in food producing area has been high. And that's like the planting season. If farmers have not been able to plant significantly, so what should we expect when harvest season kicks in? So these are like the ways that things will continue to feed. You see, on a month-on-month basis, about 1.665% in inflation. So you annualize that, you still see that food inflation still remains very high. So there's a lot that needs to be put in place for us to see a major sustainability in the reduction in inflation rates.
Gotcha, sir. Thank you. So, last time you were here with us, right, you did talk to us about building a portfolio. We asked you, I'm a 25-year-old, I think I had about 10 million. How should I build a portfolio? You gave us, foreign investments, local investments, even gold, and even a bit of Bitcoin. So I want to ask you that same question now. We're in Q3, Nigeria, September. Lots of things have changed in the economy. Most importantly, like you said, the dollar is falling, inflation is moderating, and we have this new tax regime that's coming up in January. Lots of questions. So we're going to build a portfolio, so if you don't mind, using tax minimization in mind. But I want to go through, if I could, before we go there, let's do some specifics. Let me just ask you about, say, banking, insurance, and then we can talk broadly of the tax consequence in that sector. Then we can go and build our portfolio, if you don't mind. So just to start from banking. So let's say, this is the question I get all the time. I'm in the US, I have a Nigerian bank account. I use the Nigerian bank account to send money to my mother, to pay for bills in Nigeria. If I send $1,000 from the US to Nigeria and it goes to my Nigerian bank account and I put it in my Nigerian bank account, savings account is there, what taxes am I exposed to?
Okay. So firstly, based on how how the tax treaty is also depending on where you reside. For instance, if you don't spend up to 195 days in Nigeria, for instance, you don't pay tax, because it means you don't generate the income from Nigeria. Yeah, exempted from tax, because you would have been taxed in the country where you are residing and you are working. So you don't have any fear. The person receiving the money, it is that person that may be open to a bit of tax, but it's also limited depending on the amount that is being sent, because what they will also check is the turnover in the account. So there's a threshold that they see that if the total amount being sent in the total is now up to 800,000 naira. That means your annual income now up to 800,000 naira in a month, in a year rather. It means that you will not be paying tax at all. It is when it is higher than 800 that the tax calculation begins to come in. Yeah, so sending in money for the main person sending the money will not be exposed to tax. So depending on where you are, and the UK for gifts too, there's maybe it's tax exempt, because we are, and maybe to a certain amount, to a certain level before that tax will be applied. So I think that's like the analogy that I can put into that.
Okay, what if I'm sending to my own account? I think you answered in terms of I'm sending to someone's account. What if I'm in America, I have a Nigerian bank account, I'm sending to my account? I don't live in Nigeria I don't live in Nigeria at all. I come in maybe Christmas, Easter. So what would be the tax implication? Is that what you just answered? If I don't stay for 195 days or so, you said?
Yes, if you don't stay for 5 days, I think that because it is expected that whatever monies that you are sending in has already been taxed, it is net of tax. So taxing it here in Nigeria again will be like double tax. Yes, so because if you are working there, it is expected that it would have been taxed. So that's the way I understand how that's the tax system works.
Okay, let's go to stockbroking. It's the same thing. If I buy stocks, I sell stocks, I'm a trader. What am I exposed to? I know currently we do withholding tax on dividends. If I'm buying and selling, what will change from January 2026? Can you also talk about?
Okay, thanks. So if you are buying and selling, so there's, apart from the withholding tax applies to the dividend that is being paid. So 10% withholding tax, which has always been in existence. if they pay dividend, it's the net that comes to you. But if you are buying, there's what we call for investment capital gain tax. There's an appreciation. You bought Zenith at 50 naira, it is now 70 naira. It means you have made 20 naira. Now, depending on the total number of units, so the threshold in the new rule for individuals, for instance, they will still, first of all, would apply that your total income, if it's less than 800, and they had the capital gains to hit, and everything is still less than 800,000 naira for the year, you are not going to pay tax. Secondly, they will also look at it, the turnover on your account. If the total turnover is not up to 150 million in a year, and the profit is less than 10 million, you will not pay tax. So I buy 1 million worth of GT Bank, 1 million worth of Zenith, I buy and sell, but I've not made up to 10 million. Then I'm not going to pay tax.
Is that 10 million cumulative? So if I make 1 million, 2 million, 3, is it cumulative?
Yes, it will be cumulative for the year.
For the year, okay.
It's like the turnover too is 150. So let's assume that you're an active trader, you trade a lot. You know, the total value of yours, the sale value, may be up to 150. But they will check, have you made a gain of 10 million? If you have not made a gain of 10 million on 150, then you are not paying tax at all. That's for individual. But for companies, if you are using company name to buy and sell shares, the first thing that would apply is they would check if your company, for a small company, which your annual turnover is less than 25 million, you are exempted from tax. So if your turnover in that or the company, even the shares that you are doing is above 25 million, you'll be exposed to tax, and that CGT will also be applied for company. So it's so part of what people need to look at is what's the best approach for me to be able to reduce the amount of tax that I pay. Like we say, tax evasion is
illegal. It's illegal, yeah.
Is illegal, but avoidance is legal. Being able to tax management.
Okay.
So a lot of HNIs, those that have crossed maybe the 150 threshold, will now begin to see what are the areas they can minimize the payment of tax.
Yeah.
Which will still look at what kind of investment do you put your funds to reduce the tax that you would pay, or what can you do to reduce tax. Those are the things that will now begin to be in the minds of those that qualify. If your income is above 800,000, for instance, then you check again the turnover on your accounts and how much you have made before the CGT will also apply.
Because when you invest in America, the number one thing is taxes, not even returns. They look at what's the tax event if I buy this share or if I buy this bond. We've not had that conversation in Nigeria before because taxes really are not a thing here. But I think that's going to change going forward, that you're going to see people investing with the mind that this might expose my flow to taxes, so I want to buy this instead of this. So let's dovetail into it, sir. So if let's pick a scenario, I'm a 45-year-old guy. So 45-year-old, that means I'm like an executive. I've got maybe 45-year-old. I earn very, very good. I'm way above the exemptions. Maybe I earn 5 million a month. So I earn 60 million a year. And usually I buy equities, I buy bonds, I do money markets, I pay normal withholding tax. So if that same guy, a 45-year-old guy earning 60 million a year, he does bonds, he does money market, does equity. If that guy had to build a portfolio today that minimizes his exposure to taxes, what would be the pathway? Again, just to caveat, it's all educational. We're not giving you recommendations to buy or sell. We're not holding ourselves as financial investors. We're just doing educational here. What would be the pathway for this fellow to sort of build out a portfolio that minimizes exposure to taxes that are going to come in 2026?
Okay, yeah, thanks. So I would start with, before even going to the investment, one of the ways you can, first of all, reduce that is you can increase your pension, what you pay, because you're already approaching retirement. And if you think you want to be able to have more, so rather than paying it in form of tax, you can increase what you pay as your pensions. So that would, first of all, reduce the amount of tax you will be charged. Secondly, when you now think about investment, what are those investments that are tax exempt? Those are government instruments. You know why government instruments are tax exempt is that it's like they're taxing themselves. So government wants to come and borrow money, issue instruments, and still now apply tax. It would, first of all, make that instrument unattractive. And it's still the same government that is collecting the money that would also help. So for individuals, tax is exempted for government instruments. So I would invest more. So when I have that, I would invest more in treasury bills, FGN bonds, and FGN savings bond. That's what I would, first of all, so that when they are going to apply the tax, there will be, you're investing on a net basis, they will first deduct all those ones before any tax will begin to apply. Because when you buy corporate instruments, there's withholding tax that you will need to pay. By the time they are looking at it from a company perspective, with the company book, it's not going to the interest end on commercial paper. It's not that. So that income may also be applied, tax may also be applied to the income you are also earning from CP. So you build for a conservative, because approaching at that age, you have to be a bit conservative. If you look at based on Nigerian numbers, you're already approaching, maybe you stay up, you just have 10 years, 15 years to retire. So if maybe you want to say 60% in treasury bills and FGN bonds, then you also want to now have blue chip companies, because that's not the time to gamble much with growth companies. So companies that have declared dividends consistently, So while the tax you get exposed to, mostly the withholding tax on dividend, and if you don't sell, because it's capital gain, if you have not realized the gains, depending on the volume, you would also not pay that capital gain like tax. So it's when you sell and the gain is up to 10 million in a year that you pay tax. So you can also manage that depending on how the gains on those that you are selling. How can you, maybe some stocks that are not doing well and you are making a loss, rather than continue to keep them, you can use them to reduce the gains on those that you have already also made money. So you buy that. Then for money markets, mutual funds, you don't pay tax directly, because it's expected that the returns you are getting is net of tax. So the company buying, the portfolio manager buying the instruments would have paid the necessary tax, which will now, what you are getting refund. So the interest will not be susceptible to tax, will not be taxed. But if there's a capital gain at the end of the day, for mutual fund, unit price, maybe you bought at 100 naira, and now when you look at the total volume, the unit price maybe have moved to 200 naira. It means you've made 100 naira gain, but they look at the total amount like it's for shares. If the total value that you are redeeming is not up to 150 million, you are still, and the gains that you have made is not more than 10 million. CGT, that capital gain tax will not so be applied. So focus now for people around 45 should be investments that are tax-free. That is what you begin to put more of your funds into, rather than investments that would be taxed.
So I want to just hold you. I was going to ask you before you actually went there. So in essence, I know in the States, because they have municipal bonds that are tax exempt, then we have corporate bonds that are just not tax exempt. Whenever you want to buy those bonds, you have to calculate the actual true value, the tax value of that bond, where you take the municipal bond and you strip out the tax that you're going to gain and then compare with a commercial bond. In Nigeria, we don't really do that, but I think we're going to start next year. So does that mean that there would be for instance, treasury bills, savings bonds for Nigeria that are 5,000 are paying about 17%, but the commercial bonds are paying about 2021. But if you then apply these taxes now, the tax equalization yield should then make those savings bonds be more than the commercial bond. Am I on the right? What I'm saying is correct?
Yes, I get that. So currently for savvy investors, and like with which we try to advise investors, that tax. So when you see treasury bills at 20%, and someone says I have commercial paper at 23%, you have that 23%, you discount it by 10%, that's multiplied by 0.9. It means it's 20.7 on the net. The net yield that comes to you is 20.7. Just using straight line method to calculate it. So it's going to be at 20.7. So if I have treasury bills at 21, and you're telling me you have CP at 23, it means on a net basis, it makes more sense to invest in treasury bills. And beyond even on a net basis, when the taxman also comes and they are calculating as a company, your tax, interest on treasury bills will be tax exempt. Again, apart from the nets that you have paid, when they are going to calculate your CIT, company income tax, would also be tax exempt. So you see the 30% of the interest that you are even supposed to also pay makes it more attractive for you to invest in government instruments rather than corporate instruments. So it means that for corporate instruments to become more attractive, the rates or the yield would have to go up. So that when you look at the net, because when you multiply the 0.3% of the interest you are getting, at the end of the day, you would also discover that the return you are getting is really very low compared to investing in. So we'll begin. So now there will be more consciousness. What we are saying is correct. More consciousness around that. Most people, and that's why, because we are not used to it, you see a lot of questions around how does it affect me? How does it affect your investment? So the taxman now, this is their time to shine. A lot of consulting work. Now a lot of, I believe that a lot of investor education would also coming up for them to be able to understand how to manage their portfolio well, to reduce the amount of tax that you'll be paying, or even structure. You receive money in your personal account, for instance, and you're using it for business. No one will understand that. They will just see, by the time they look at the turnover on your account, you just apply the necessary tax. But if you move that to where you can apply, your turnover is about 25 million, and you know that you still fall under small companies. It means you won't be paying tax compared to having that 25 million in your personal account, because your income has already crossed 800,000.
Yeah.
They begin to apply tax after 800,000 on your annual.
And just to be clear, that's a tax equivalent yield. That's what we're trying to remember, tax equivalent yield.
Yes.
Okay.
Yes, tax yield.
So just scenario. So a current bond today, a current commercial paper today that is paying 10%. If the tax regime goes into effect January 2026, that tax bond, the yield when compared to a federal government security has got to go up from say 10 to about 13 or 15%. If that bond yield goes up, that means the price is going to fall. Am I on the right spot?
Yes, that price is really going to fall.
If the price is going to fall, what should I do today? If I hold that bond today, should I hold? Should I sell? This is a trading question now. If the price is going to fall, do I get out now, get back in?
No, so for for bonds, once you already know that the price, if the price is going to fall, it means that the yield will increase, then you get out now. Because at that time, based on when you do your mark to market, you will be in a loss position.
True.
You are not going to be holding to maturity. So the best thing is that you want to short, we call it short, that means you sell. Now, with the hope to buy it when the price go down, and by the time people think the tide will turn, then you begin to make profits.
Well, what then happens to the large holders of bonds that are not going to sell? Like a PFA is holding 100 billion in bonds or bills. They can't just sell 100 billion. The market will crash. So they would have to eat that. They would have to eat that fall on their returns. It will be marked lower. Is that what's going to happen? Should we see?
Yes. So because it's what we say mark to market based on the value. By the time it means that the value of the portfolio for the bonds that is being held for trading, or available for sale, based on IFRS 9.
Yeah.
So it's not holding it to maturity. So some of the bonds might have been classified as held to maturity. For instance, you don't do mark to market. It means they have demonstrated the capacity to hold it to maturity, and they will not be selling. So what we typically see in the banks, you would see that when they see that there are fluctuations in some of their bonds or portfolio, you classify it. That bond, they are not going to sell it. They are going to hold it to maturity. So we think that most of the PFAs, since they have the ability to also hold for long, will be holding most of those corporate bonds. You see, most corporate bonds, the highest number of years you see, maybe it's 10 years. And they have ABM bonds of 30 years, for instance. So to them, it's really not a big deal.
Okay.
And you see that affecting significantly the return or the performance of the pension funds.
Okay, let's talk about dividends. So lots of questions again around dividends. If I buy, this guy has bought, like you said, you should buy treasury bills. You said you should buy blue chips. If blue chips come into his portfolio, it's going to be taxed withholding tax. Is that all they're going to tax him? He doesn't have to worry about anything else once he has paid the withholding tax on dividends?
No, like I mentioned, for individual, the total sale, if it's up to 150 million, and the profit on your investments is above 10 million, the 30% CGT would apply. So for the individual, they will graduate it. Maybe it's based on the class of revenue where you fall. Maybe it's the 10%, 20% that would apply. But CGT will begin to apply once you cross that threshold.
But this guy didn't sell. He just bought. He sent money from America to Nigeria. He bought shares of GT Bank. He's sitting in the CSCS. He hasn't sold, so he gets a dividend annual.
Because you've not realized any gain.
Perfect. Okay, that's that question. Okay, so we've talked treasury bills. We've talked blue chip. We've talked money market, right? And I think you're saying 60% in treasury bills. That's what you're advising this guy to buy.
Government, both FGN bonds and government for conservative.
To take advantage of the tax position, I understand, yeah?
Yes, to take advantage of it.
Then blue chip, you are still going to blue chip because of safety, security, even though it's going to pay a dividend, they are saying, hey, do blue chips. What's the percentage for blue chips, would you say?
Yeah, so I would say that you should do 20%.
20%, okay. What about money market? You mentioned money market as well. That's going to give us our liquidity, although that exposes us a bit to, should we say, to dividend, to taxes. But how much we do in money market?
No, money market too can be 20% at that level because it's the net. So if your return is 20% on mutual fund, it's expected, when the portfolio managers purchase these instruments, they would have taxed it. When they pay dividend, is the net that has also been taxed. So indirectly, the value of your portfolio is net of tax. So you won't be taxed again. except when there's a major capital gain. So it's going to apply to mutual funds like equity mutual fund or balanced mutual funds, that their price can change. But you also, when you look at if the gains that you have made is also not up to 10 million and the total turnover is not up to 150 million, then you won't be paying tax. So you will see one thing is recurring in what we have been discussing. It's like a progressive tax. So trying to tax the rich, there's a data that says that people that earn 1 million or 2 million above in a year is less than 10% of the economy. So it's those 5-10% that now begin to worry about how they need to structure. The average Nigerian that's maybe your total turnover is 1 million, 2 million in a year.
You're not going to worry about that.
You actually don't have any worry about tax.
If there was no tax reform, would you still recommend 60% treasury bills, 20% blue chips? Because this portfolio, you're recommending 80% fixed income. He's 45 years old, about to retire, I get it. But you're recommending about 80% fixed income, just 20% blue chips. If there was no tax reform, would you have done the same recommendation?
No, it would have, there will be a slight, so most times you would maybe want to do a maximum of 60% to equities.
Oh.
Then, 60% rather, I take that back, 60% to fixed income, which includes treasury bills, FGN, you would do more in corporates. If you know that the tax that will apply to corporate is not very small, then you take advantage of the high interest in the corporate environment and even placements. If you're able to negotiate a net placement, then that gives you higher return, then you want to do more of those things. Then for the fixed, for the equities, blue chip, maybe you would have done 30. I would recommend maybe you do 30%.
Gotcha.
In a mixture of 20% blue chip and maybe 10% growth stocks.
Gotcha.
Yes. Then
understood.
For that 20%, you can also look at ETFs. Maybe you do if you want to get exposed to dollars. And
is that going to be fixed income ETFs or equity ETFs?
I would say 50-50 of what is left. So if you look at VOO ETF has returned an average of 18% in the last 5 years, say for 2022.
VOO is an ETF that is tracking the US, the top 500 US stocks.
S&P 500 stocks. So you would see that it has consistently delivered in terms of returns in the last 5 years.
Yeah.
Average of 15 to 18%.
Gotcha.
So I'm getting, even if you are getting 10-15% in dollar return, is significant.
Okay.
And it's susceptible to less volatility. Then you also now want to maybe just also look at even Nigerian ETF.
Gotcha.
Or you look at gold. Gold also preserve value. We've seen the return on gold this year is about 12-13%. It's done average of 50% in the last 4 or 5 years too.
Yeah.
So we'll just create a very stable portfolio that no matter what is really happening around the world, your portfolio average return would at least almost be close to inflation. You break that gap, even if it's not beating inflation. Because you look at equities this year, looking at the consumer index, return close to about almost 90% return this year. Insurance have done 76% this year. So you would see that why we don't expect that it's on the every year that will happen, because it's on the back of they're coming from a low base based on the FX impact last year, and now most of them are returned. So you always see that, and if the person is consistent, one thing about investment is that you have to be consistent, doing it over time. So you are averaging, we call it dollar cost averaging, or whether it's not averaging. You set something aside that every month, this is what I want to be. I have 15 years to retire. I want to start, this is the amount out of my 100K, 60K goes to fixed income, then 20K goes to equities, 20K goes to both US stock and US ETF. and as well as Nigeria ETF, and you are consistently doing that every month, and you are pound, because that's magic of compounding. When your interest comes in, you add it back. When they pay you dividend, you add it back. You'll be surprised. You'll be so amazed on what you would have been able to build in 15 years before retirement.
Fantastic. So on YouTube, I'm holding up my board with what you've said, just to explain the asset allocation. Let me go over it again, sir. So what I understand is that because of the tax bill that has been passed, this guy is going to be, this 45-year-old guy that earns 5 million a month, 60 million a year, is going to be exposed to paying more taxes. And then you are basically suggesting that for him to reduce and have a more tax efficient portfolio, you should do 60% in treasury bills. That gives him fixed income, guaranteed fixed income, because he's going to retire very soon. But with
treasury bills and FGN bonds.
So let's just call it FGN bonds and treasury bills. All those the sovereigns. Let's call it sovereigns, right? So you should do 60% in sovereigns, yeah. And then you also are then saying 20% will be the money markets and all that. That will give him a bit of higher yield, but would expose him a bit to that tax, right? We get that. Just to prep up the portfolio. They are doing 20% in blue chips. Blue chips because it's going to get a dividend, right? So it's 20%. Yes, it's going to be exposed, but it's 20%. If it's not selling, there's no capital gains on that. If it's just holding, he just gets the dividends in. He will pay the withholding tax, but at least it gives his portfolio growth. This is for a guy that is well off with the new tax regime. When I asked you about this same board without the tax regime, that would be a guy, even today, that is earning, say, $1 million a month, because the new scheme might not apply to him in that progressive tax setting. So how you change it for the person that's maybe earning $1 million naira, because he's going to get about 12 million, he's not going to get hit that hard under this new progressive taxes. You said, okay, we should go more, instead of doing sovereigns on the fixed income, we will then do more of the corporates on that fixed income side, about 50%, but more of the corporate, i.e. these commercial papers and all that. He's not too worried about taxes there. You also talked about going the blue chips up to about 30%. So he's going to buy 30%. He's going to also spice up that portfolio with gold, with ETFs. Asset classes, you mentioned the VOO, buying dollar-denominated mutual funds that could also give that portfolio a lot of dividend returns coming to the portfolio, because we're not too worried about taxing the dividends at this stage. He's a growth guy. The 45-year-old guy is more of he's approaching retirement, more of a income guy. Did I summarize that appropriately?
Yes.
Perfect. And I have it up here on YouTube. Guys can see my little nice whiteboard, high-tech whiteboard. So I can do that on the. But I have a question. Someone just asked me a question. What if I sell my shares above 450 million? I've crossed that threshold, but I immediately go back and I reinvest what I sold to just buy new shares. Do I get an exemption, or I will still pay tax on that sale and then buy with my net? So how does that work? Will I get an exemption if I just take that money, even like $1 billion? I sell $1 billion, but I take my $1 billion and buy shares immediately. Is that an exemption, or I still pay the taxes?
No. So I think what has been done is to encourage reinvestment in the country. If you also reinvest the proceeds, I can't recall the threshold now. There's an exemption for reinvesting, so you are not just taking it out. You are exempted from paying tax because you have invested that proceeds. Because what that bill or that act is trying to do is to encourage that you continue to, because the more we're able to invest in this company, the more they have money for them to also grow. So you would also be tax exempt. What I can't recall now is maybe there's a threshold. You sold 1 billion. Is it when you buy with the 1 billion? Is it the total 1 billion is what you would pay back? But I think I will try and get that before we.
Okay, yeah, just to make sure that if I do a sell, even if I'm above the threshold and I sell, I'm able to say, will I get taxed if I do a reinvestment? I think the answer is you will not get taxed. But like you said, sir,
you will not get taxed.
Okay,
yes.
let's go to questions. I know a few guys had tried to speak. Just take a few questions, guys. I don't want to. I have a lot of questions, but I want to ask you guys to speak. If you want to ask a question for him, send me a message on notifications or DM on YouTube or just here. Ifrex, I've got Ifrex Trading. How are you doing, Ifrex? Good morning, welcome. Do you have a question for?
Yeah, good evening, Mr. Aja. Good evening, Dr. Ayodeji. I like what you are doing. Please, I have a question. And the aspect that my question is on the tax reform. So now my question goes this way. I know that if you own a business, if you are operating under a business name, and your total income is up to 25 million a year, that's when you will be taxed. Am I right? So
yes, it's so you're classified as a small company, so zero tax.
Okay. So is it company like CAC company? You know, you just registered a business name and then you're using your business name.
Full company like limited. I think we asked that question yesterday and they clarified that it has to be a company, not business name, not enterprises, not business name like limited. That's what they qualify for that 50 or 100 million. So if you do limited, if you do like business name, enterprises, that's going to be personal. You would pay personal income tax. But if you then do limited liability company, that's when you then graduate to 50 or 100 million.
Okay, thank you about that. And how about companies like, let's say, incorporated companies and then LLC and the limited? So these are there's no tax advantages, like this one has more advantage than this one when it comes to the interest on the tax, the percentage. I don't know if you understand my question now.
Are you asking if I'm a personal or a business tax, are there different tax rates? Is that what you're asking?
Like someone that owns a LLC, LLC is different from incorporated company, and then on the limited liability company, so is there any kind of differences when it comes to tax, or are they taxing them the same?
I know there's a threshold. Like if you're a company, I know you are, once your turnover is 50 million, because there are two numbers in the act, I found out yesterday, 50 million or 100 million, then you don't pay tax if your turnover is below that number. Once it's above that number as a limited liability company, that's when you then start to pay taxes. So it's 50.
Okay.
Because for what I understood yesterday, I'm sorry, I don't know, did you know this in the act? There are two numbers in the act. There's 50 million and there's 100 million, because there are four separate tax laws that were reformed. One of the tax reform has 50 million, the other one has 100 million, and how they define small companies. So that's why I'm saying 50 and 100 is once you cross that threshold, then you start to pay your taxes here.
Yes, for small companies, 25 million or less, medium 25 to 100, you pay 20%. That same rate is what is applied as CGT. Before CGT is just 10 flat, but now it is the company income tax that you're paying. That is the same rate you pay as CGT. So 25 to 100. Then when you are above 100, you are paying the standard 30% corporate, and your CGT will also be 30. So you are classified as a large business, limited liability business. So
okay, so just keep that in mind. If business is totally different from personal, yeah. All right. Ifex, thank you so much. I appreciate that call. Ivory Clark. Go ahead, sir.
Yes, hello. Good evening.
Good evening, ma'am. How are you doing?
I'm fine, thank you. I want a clarification, please. I've been getting conflicting information with regards to treasury bills. I was told it was tax-free and then it's no longer tax-free. But Mr. Ayodeji speaking seems to refer to treasury bills like they are tax-free. So is it tax-free or is it not tax-free today?
Okay, yeah, today. So what happens? I get a lot of questions around that too. If you're investing, if you buy primary market, investing in your personal name, it is tax-free. But if you are investing through a company, most times those companies pay tax on treasury bills. So if you are investing through a company, because they will pay tax, they aggregate it. And it's not like they are buying it in your name directly, though they redistribute it to you. Because they will be paying that tax, they will charge you the tax. That's where they will charge you that tax so that they don't have to be the one to pay the tax on your behalf.
So, Mr. Ayo, let me see if I understand what you're saying. You are saying that there is no tax per se because treasury bills don't pay dividends. But that when but when I buy from, say, Kalu Limited will charge the buyer that tax that Kalu Limited is supposed to have paid. Is that what you're saying?
Yes.
Okay. All right.
They will charge you. So that's why you see individuals. You see some people, if an individual buys directly, like PMA that is 50 million, you go to the secondary market, they buy in your name, it settles in your name. You are not going to pay tax on it because it's individual. But you are buying through most of the investment outfits, aggregates the funds and go and buy in bulk. It means they will pay tax, and to make it worthwhile and looking at business sense, if they are going to pay tax, they would definitely charge you that tax. Gotcha.
Well, a lot clearer, Ivory?
Yes, thank you very much. Very clear. Thank you.
Perfect. It's a Chikwelu. Hi, welcome, sir.
Hey, hi, Kalu. Great conversation as always. Good to have you here. Yesterday we spent, I think, over 3 or 4 hours.
3.5 hours on taxes.
Yes, and if I will be honest, folks are still confused. So, I'm going to ask you, I think I have like 3 questions, Kalu, if you will permit me.
Sure.
The first one will piggy off the last question. Ayodeji, if someone wants to go direct to the market on TB, that means the person is 550M and above. What's the tax? That's one. Should I ask the 3 questions or should we deal with this one? Then I'll ask the next one.
No, you can have the 3. I'm writing.
Okay. So if someone wants to just go in with 50M direct to the market, what's going to be the tax? That's 1. 2, let's come back to my back and forth with Kalu yesterday. Equity. So you bought shares. But the thing was, you bought these shares way back, when the market was down. So it says 150M. If the profit is 10M, you pay tax, right? Pay 30%. Is it 30% or 20%, right? So let's assume that the total volume of what you sold was below 150, but your profit is still above 10M. For instance, if you got into the market quite early when you were, when market was super depressed and you spent 1 million naira on a share, and at the end of the day, the share today might worth over 30 million, right? And you decide to sell. So even if you are just selling 50% of it, you are above that 10 million naira profit. I want you to talk about what's going to be the tax. The third one is a bit tricky. The third one is, what if someone decides to open a limited liability company, right, and now transfer his or her portfolio to that company in order to go under the 50 million mark? What will be the implication?
Can you ask that third question again?
So, what if an individual decides to go to CSE and register a limited liability company, right, in order to have to come under the 50 million personal tax allowance, then transfer his or her portfolio, equity portfolio, to that company as an entity, right? So the company now owns the portfolio, right? The individual is either the chairman of the company or whatever, depending on how you choose to structure it, right? What will be the implication? First off, would that transfer be possible? One, and what will be the implication in the context of tax? This new tax law coming.
Okay, thanks. So on the first one, if you said the treasury bills 50 million and above, and you invest, if you are investing in your personal name, you will not be paying tax on government instruments. You will not be paying tax. You only pay all those custody fee and stuff. You won't be paying tax.
Just to be clear, 50M will give the person direct access to the market, so you are not going under anybody to aggregate.
Yes, so they won't charge you. They won't charge you the what we call the withholding tax that they're supposed to charge you. They won't charge you tax on that. Or you know that when you now start, by the time they're looking at the income, you know, there's the personal income tax.
That's
Personal income tax. When they are calculating your income will be hello. So, yeah.
Sorry. So we are getting a feedback. We're getting a feedback from someone.
I've removed him.
Okay. Your answer is quite important. So please just repeat again.
Yes. So I would, if you're, as an individual, you invest 50 million and above in treasury bills, you will not be charged withholding tax on that investment because it's individual. But when it now comes to personal income tax at the end of the year, let's assume you made 20% on 50 million. That's like 10 million that you have made. It means that you have crossed that threshold for your personal income. You have crossed 800,000. When they are calculating your personal income for the year, they will graduate it based on the charges that should come, because you are no longer below 800,000 income per month. You've earned 20 million from an investment. So it's not withholding tax that you'll be charged. It is now the personal income tax that will now be graduated based on the calculation: 0, 15%, 20%, maximum of 30%. Based on, so that will apply when you are doing your tax returns for the year, because it's an income.
Okay.
I don't know if that's clear.
Yes, it's super clear. That means the person also have the option of using that registered company to buy the treasury bill.
Yeah.
Right?
Yeah.
So if you buy treasury bills with a registered company, you will pay withholding tax. Like I said, it's an individual that will not pay. You will pay withholding tax if you are buying treasury bills with a company name. So if I go into your next question on the shares, and if the share price is down, so what they will first of all check is the total turnover. If the total turnover is not up to 150, even when you sell and your income, what I see here when I try to check the rule is and. We didn't say or.
Yes, and is the key word there.
And so it means that the two conditions must be fulfilled before it can apply. So if your turnover is 1 billion and you have not made money, there's nothing they are coming to tax. You have not made up to 10 million. You see that means you are not doing well portfolio-wise. So why should they have to be burdened for you? So I'm looking at it logically. But if the turnover is 150 and you have made 10 million.
Sorry. Let me call you back. The turnover is not 150. Let's say the turnover is 50 or 70, or your profit is way above 10 million.
You will not pay tax. That's why I said it's and.
Both conditions have got to occur.
Yes.
Okay, this is sounding like the 2023 election where they said Abuja has and or, but continue.
No, when you check is based on the rule, and we'll continue. But what you can find in the rule is and. It means that the two conditions have to happen before you will be taxed. So even if you have made 20 million and the value of your investment is not up to, so they will be waiting. You know that you will accumulate, you will grow. So assuming you made 20 million this year and you are under 100, next year it means you will have 120. What they are trying to do, when you look at it logically, is they encourage people to invest and continue to grow. So by the time in 2 years' time, there's no way it will not enter 150. If you continue to grow at that pace and you are now ripe to, or you join the league of those that will now be taxed capital gain tax. So that's like the logic. So they're just trying to encourage people, save. If you are not up to this threshold, we will not tax you, we will not bother you, and you are not making money from your investments, we will not bother you. But once you start to make money from it, then we begin to charge you tax. So when you look at that threshold, it's almost like a yield of 6%. They expect that at least minimum, if you invest 150 million, at least you should be able to make 10 million from it, which is about 6% yield.
Okay, I think so. I mean, it's a very, so essentially, you have to first of all qualify for turnover and then qualify for the 10-year for the 10 million naira in the year. Both conditions have got to, okay. Yeah, here the third question, is it? What's the third question?
So his third question is that if he can transfer his shares. So if you look at, based on what we have answered, that for your individual, if you sell your shares, what they will look at is, first of all, the total income that you have earned, is it above 800,000? If it's above 800,000, or it's less than 800,000, and they had the gain on your shares, and everything is above 800,000, then you will be taxed. So it's what they are trying to do is that they are encouraging people to even have investment in a company, because if you move the money from your individual to your company, it means that your turnover must cross 25 million before you will be taxed. But that's trying to just encourage that you are setting up having those things in your individual names may not expose you quickly to tax. But if you think that because you don't want to be taxed, you are running to have it in your company name, yes, they see you clearer then, and they see that as you grow, you pay tax. But investments in company names also comes with tax. Like the treasury bills, the benefit you get as an individual, you don't get it when you invest in a company. But for shares, withholding tax applies to everyone. It is CGT that you may be exempted because you qualify as a small company, 25 million.
Gotcha. All right, that was well done, sir. Thank you so much, Eze, and thanks for the questions. Let's take Npire.
Sorry, it's Empire.
Empire.
Yeah. Okay. Good evening, Kalu.
Could you speak up, sir? I'm so sorry, the audio is kind of low. If you could speak up, please.
Can you hear me now?
Yes, better.
Okay. I was just greeting you all. Okay. To save time, I want to go straight to the question. That's your clarification, I would say. Now, we said something about the tax, per se, like when you are filing, the tax is being levied on profit, per se. So let's say when you are filing your tax returns, you make deductions and all that, and then when you have done your deductions from the net profit, that's where the tax will be paid from, right? If I'm correct.
Yes.
Okay. So now my question now, I want to direct it to Deji. Ayodeji, sorry. If you now happen to, from that your net profit, let's say your net profit happens to be for individual, not company, for individual, personal income. You now happen to invest, it happens to be something like 50 million or so. And you now decide to invest 49.2 million in TB. Would that be a ground, like, would they still tax you on that personal income? Knowing fully well that you have invested 49.2 M in TB, which, if I understand your concept, you said is not taxable. Treasury bills, that's what I mean by TB. So if you invest that 49.2, automatically what is left as your net profit is 800, which is under the exemption cap for personal incomes. So this logic per se, do you think is possible that when you are filing your tax returns at the end of the year, and after making your deductions, they find out that you have 50 million profits, can you
Profits?
Investments in TV? Huh?
No, you are saying
profit. Hello?
Please go ahead. Go ahead.
Yeah. So now when you are filing your tax returns with the taxman or the tax officer, and they, after making some deductions, they find out that your net profit is 50 million, can you still raise that investment in TD as another tax deduction, advantage or something? Just, since you are investing that 49.2 in TD, what is left from your net profit is 800. So can you use that investment as TD to escape, or let me not use the word escape?
Perry, we've got the question. Yeah.
Okay.
Yeah. Sorry, his audio was cracky. I don't know if you heard him.
Yeah, so I think I was able to think about it. But one thing we need to first
can you mute Empire? Can you mute Empire? Empire. Can you mute? Please mute. Yeah, go ahead, sir.
Yeah, so the first thing is there are different taxes. So if you can, it will almost be impossible to run. So if you look at from the personal income tax, which applies to you, there's the withholding tax, which applies to investments. There's the VAT, you make transactions or you provide services that you also be paid. So even if your income is less than 800,000 and you go to high-level restaurants to eat, there's in Lagos, there's consumption tax, there's VAT that you pay. So, you will need there's capital gain tax. So even if once they look at your threshold, so at above 800,000, it means you already pay personal income tax. The income you make from that, you have been taxed personal income tax. Then you now invest in treasury bills. You will not be taxed withholding tax. But the income you now make from the treasury bills, by the time you are calculating it in your personal name, it means that it will add up to what you'll be taxed as personal income tax. But if we move that to a company, for a company, you will pay the withholding tax when you are investing, and for treasury bills, you is exempted from company income tax if it's a government instrument. So that's then the capital gain tax. If we look at the gains you have made on shares, capital gain tax doesn't apply to fixed income, except if you are a trader. If you are trading, you are doing in and out. It means it's based on the price, your mark to market, and you see that you've actually made significant, but they will apply capital gain tax. So that's we need to note the difference. So if you are trying to avoid tax, which of the tax are you trying to avoid, and which impact do we need to have? So it's not just general that because you are earning below 800. Below 800 means that you will not be paying personal income tax. But that does not exempt you from VAT. You go and buy something in one supermarket and they charge you tax, no matter how small.
I have a few questions. What I heard him saying, I think number one, he was saying profit. He was saying profit instead of the actual purchase.
Exactly.
But let me. I don't think it's not profit. But if you're an individual takes 49 million and buys treasury bills, and so treasury bills are not taxable. So are you saying that individual will pay would he pay withholding tax one? And when he gets, because there are no dividends in treasury, let's talk about bonds. Treasury bills have no interest, right? Does it change if it's treasury bill and bond?
It's interest-based. It's still interest-based. So you will not pay withholding tax as an individual.
On treasury bills.
On treasury bills.
What about then when it gets to maturity and you get your 49 million, because you're going to buy at a discount. So if I buy at 48 and I get 49, that extra 1 million, are they going to tax the individual on that extra 1 million?
No, it still is the interest. So they are not taxing you. It's not a capital gain tax. It's not based on appreciation.
So
it is the interest directly.
Okay, I just want to get, I want to go somewhere. So for the treasury bill, the individual, if he buys for 49 million, what will he pay?
On treasury bills for individual, you are not paying any tax.
Even if he buys at 49 million, he wouldn't pay any tax. 49 million, he wouldn't pay it. Okay. What if he bought a federal government savings bond? Would he pay any tax as well?
No, you are not paying any tax.
So for an individual, irrespective of the amount he's buying, as long as it's sovereign, he will not pay any tax.
Yes.
Okay.
I even think for FGM bonds, for corporates too, to encourage people,
okay,
they are not taxing.
So, yeah, corporate is very clear. I was just really concerned about if the individuals also enjoy that, because so the point is both for individuals, corporate is the instrument, not the buyer. Once you are buying a sovereign, is tax exempt, just like in the US.
Yeah, exactly. That's where I want to draw the line in my question.
So is that correct, or that you are?
Yes.
Okay.
Is the instrument not?
Okay, so that's clear. The answer is answered. Yeah. Okay, perfect.
Yeah. See, can I, hello?
No, real quick. So your audio is very bad. Real quick.
Okay, yeah. See, that's exactly what I'm trying to say now. Yeah. Now, mind you, I said something about the net profit. Now, from my own personal income, I have 50 million net profit. Yeah. So now investing that 49.2 million. Will it be a kind of another tax exemption for my personal income tax?
His answer, he has answered that once you buy a sovereign, there's no tax.
Is that okay? So that's good. Thank you very much. Yeah.
You're very welcome, sir. Let's get Oxley Tech. Oxley, please go ahead with your question. Oxley Tech, please go ahead with your question. Sorry, guys, if you request to speak, just stay near your mic. We'll call you, sir. Obuma P. Please go ahead, sir. Obuma P. Let's get the entrepreneur. Please go ahead.
Okay, yes, I'm here, sir.
Go ahead. If you request to speak, sir, please hang around your mic so we don't. Yeah, please go ahead, Obuma.
Okay. Yeah, my question is with regards to the exemption rate, I think I'm hearing like 50 million is or whatever it is, whatever the amount is that won't be taxable. What if you decide to open different brokers, per se, and then have that particular amount?
No, he just said it's the sovereign
amount.
Obama, just to be clear,
will SEC aggregate everything together?
It's not the amount, it's the instrument. Yeah. So once you buy any sovereign instrument that is issued by the federal government of Nigeria, you will not pay tax. That's what we're saying. So whether you put $1 billion or $1 in a sovereign, you don't have to go and open up 50. You will not be charged tax. That's what he's saying, sir.
Yes, correct.
Okay, no matter the amount of
50 million threshold, even if you put 1 billion as an individual in, you will not pay withholding tax. But at the end of the year, because you have made income, which is in form of interest, in these instruments, whether in federal government, they will now apply tax to you as an individual because your income is up 800,000.
So just to be clear, explain that again, Mr. Ayo. Just want to be clear on that. He buys.
If he buys 1 billion worth of treasury bills as an individual, he will not pay tax. But at the end of, he would have made, let's say, even at 20%, he would have made 200 million. It means his income level as an individual is already above 800,000. It's not under the zero tax level again. At the end of, we'll pay personal income tax, not withholding tax now.
Because you are assuming that because he can buy $1 billion, he has $1 billion net worth.
He has made income. What they are looking at, if your income level, annual income level,
understood,
800,000.
Understood.
So now the income you have made on that investment is
would push him. Gotcha. All right. Hope it's clear. But he's when you won't pay
such a way that in each portfolio it is under 800,000.
But you are making the income. You are making the income. Doesn't matter how you spread it. You know, you won't pay the tax.
That's why they will use BVN. They will see all the transactions. Like it will go through your bank account.
Okay, everything will be aggregated together, even if
no, but even if you are, I don't want you to get the wrong impression. Even if you manage to spread around, you are making the income. So the income is going to push you above the 800,000. So it doesn't matter where you are spreading it to. When you buy that 1 billion worth of treasury bills, you don't pay the tax, Abi, but then your income, your personal income will push you above 800,000 naira cap, which now exposes you to taxation according to that personal income tax table. You see what he's saying?
Okay.
Yeah. All right, perfect.
Yeah, it's clear now.
Excellent. Okay, let's get Oxley Tech. Oxley Tech, please go ahead.
Yes, Kalu, can you hear me?
Yes, sir.
Okay, so the question I have is this, right? I understand the thresholds that the new tax law has set in terms of income. Now, what if you have a scenario where maybe you are in the service, you're a consultant or you are in the service sector, you do a job for a company, you raise an invoice, they pay you tax. They pay you they pay you for the services that you provide or you provided to the company. Of course, in that invoice, there is going to be a VAT. Now, at the point that the company wants to pay you, the company pays the VAT to FIRS and also does a withholding tax. They do a withholding tax before paying you the net. Now, let's say in a year you did 5 jobs for 5 companies that charge you withholding tax, but at the end of the day, by the time you do your financial statement, your financial reporting, you didn't get to that threshold that qualifies you to pay a net tax to federal government as a CIT. Now, what happens to those your withholding tax? Because those withholding tax was charged. Some service providers know what I'm talking about. The withholding tax was charged by the company before they paid you the net of the services that you provided to them. At the end of the day, your withholding tax has been collected, but net on net, at the end of the year, when you are filing your financial statement, you didn't meet the income threshold to be able to pay CIT to the government. What happened to all those your withholding tax?
You claim it back.
Yeah, so I think you would be able to claim it back. So part of what I know Mr. Taiwo Dele was saying that, before the way to even claim when you have tax credits, when you say tax credits, claiming it in the past also takes long. It's very cumbersome, so people don't even pay attention to it. But I think the process of claiming it now has improved, and you'll be able to claim it. So by the time you're supposed to begin to pay tax, there will be tax credits for you because you have been charged the tax that you are not supposed to be charged, and that will also be nilled out. So I think that's I hope if anybody has more idea around that space, I think.
No, I think even before the tax relief, the withholding tax are supposed to be cleaned back. It was just cumbersome. I know you get those little slips that are saying tax withholding receipt, and you're supposed to go back and claim to reduce your actual tax spend. It's not it's the procedure that's the problem, not the actual tax withholding. That's the problem with Oxley. It's just the way to get it back is hassle. You get the certificate, but you go to FIRS, it's a big issue. So hopefully now they have maybe made it easier to take those certificates you've collected and then to reduce your taxable gain. That's just the it's not the paper, it's the implementation.
Yes.
Yeah.
So the question is also that would you have filed your financial statement for the year and it is determined from your financial statement that you qualify, you are not supposed to pay any tax before you go after the withholding?
No, don't say that. So look at it this way. The withholding tax is very, very simple. If you, for instance, bought generator, the company charged you with, for instance, just example, took withholding tax. They've taken their own. They are done. they give you a certificate. I get your question. You now go and file. When you file, government is owing you taxes, but you are already, but they're also coming to you to claim taxes from you. That's the question. So you are paying double in that government is asking you to pay tax and government is not refunding your withholding tax. That's a good question. What I'm saying is that the issue is not the policy. It's just the way you can easily get that your certificate back to you. It's very cumbersome. I used to work in a company where we piled up withholding tax. We could never ever get the credits back to the company, but you get all those withholding tax certificates. So it's not the actual, it's the implementation of what they are seeing on paper that you, Oxley Tech, can go give them a certificate and they'll write that off. Because when you pay your taxes, you can write it off and say you can reduce your taxes even next year. It's a credit to you. You've paid somebody, they gave you a piece of paper. That piece of paper is a credit that you can't put back into your account easily. But on your report, on your annual report, what you say, what do you put in annual report? You put tax credit, Abi. You put tax credit there and you put your receipt. Don't you attach it there in your annual report?
Yes, I understand that. So my last question is, what about withholding taxes that are charged by foreign companies? For example, you sell on Amazon. Amazon charges 30% withholding tax to Nigerians.
Is there a double tax arrangement? That's the same answer.
So, and Nigeria doesn't have a tax treaty with the United States.
Then that's all. And it's a cost of doing business. It's gone. It's a cost that you have to bear.
Correct.
Kalu, please let me jump in. Closely related to what Oxley just said now, right? To Mr. Ayodich, right? So when it comes to trading shares, trading stock, right? Whenever you sell or you buy, there's always a withholding tax, 2% buying, what's it called, 3% selling, right? So what at the end of the day, at the end of the year, sorry?
Is the VAT on the commission, not withholding tax?
On the commission is what you're paying the VAT on.
Okay, so you're not going to get that back at the end of the year.
No, they give. What happens is they give you a piece of paper that says you have this credit, and what you're supposed to use that piece of paper to apply to reduce what you paid. Because when they charged you, then you reported, you got a paper that says you have credit. What Oxley is saying that paper is very, very difficult to plow back. He has paid, but they can't get the credit back to his account. That's what he's complaining about.
Okay, but I'm trying to apply that in another context, not in the service context, in the context of stock trading. So at the end of the year, if you trade stock, buy, sell, and all that, and at the end of the year, like we discussed before, your turnover wasn't above 150 M, and your profit wasn't above 10 M. With the tax that you paid, will you get that back?
No, it's a dividend. You are paying withholding tax on dividends. I'm sorry, am I correct?
No. I mean when you sell. No.
That's capital gains. That's a different thing. Capital gains. So that one is simple. You bought at 10, sold at 20. You are paying 10. They've taken it. There's nothing to get back.
Yeah.
Okay, so the 150-10 threshold is when you go above, when it goes to 30%, right?
That's when it triggers, yeah. So if you sell and you make a profit, have you made more than 10 million, number one? And what is the total turnover? Those two have got to, so yesterday we said you have to sell at 10 million naira increments to avoid capital gains tax. That's what we said yesterday. If it goes above 10 million for the year, you trigger that capital gains for what is above 10 million. So you can make 100 million, but you have to, that 10 million is all you can get for that tax year. If you take more than 10 from your broker, and Ms. Ayo, can you also step in? Because how would it work? If I sell $1 billion,
exactly, that's the confusing part.
If I sell $1 billion, does that mean that I have to then claim the 10 million every year?
No, if you sell $1 billion worth of shares, first of all, you met one of the conditions is above 150 million. The second condition to fulfill is that did you make up to 10 million? If you make above 10 million, you will pay capital gain tax.
Okay, so once those two occur, so I can't say I made $1 billion, but I'm taking out 5 million. I can't say that. It's once I hit two of them, boom, I pay the tax.
Yes, so it's for the year.
Fair enough.
It's going to be cumulative. So you can't say that you sold 500 million, you made 5 million, you take that out. The next one, they look at everything for the year.
So it's essentially once. So you can hear what I said. Once it is cumulative. Once if I sell my first one, 1 million, 7 million. Once I hit 3 million, boom, I've qualified. We pay. That's what it's so simple. Yeah. Okay. Fantastic. Thanks, guys. Let's take Otedola. Otedola. How you doing, sir? At the suing. Sorry if I misspelled that.
Good day.
Good day, sir. Hi. Go ahead.
Good day. Yes, sir. Okay, I'm coming from the angle of an entrepreneur.
Okay.
I run a business and all of that. So lately, because of the charges that cannot be explained with these Nigerian banks. By the way, I have a limited liability company, so I have account to that effect. But because of the charges, I stopped using that account and I had to open another business name and proprietorship and all of that, which I hardly use also. Currently, I use my personal name for transactions and all of that. Now, in the light of this tax, what do I do? Where do I fall in and how does it favor me? That's my question, sir.
Did you hear him, sir?
Yes, I'm trying to process it. Can you summarize it?
Yes, sir. I am a business person, an entrepreneur. I have a registered business liability name, and I also have a business name, which is the proprietorship and all of that. But because of charges, I was trying to escape the bank charges and all of that. So presently, I use one of the fintechs to run my business and all of that. Now, in the light of this tax, trying to, like Carlos said the other day, he said that tax evasion is illegal, but avoidance is legal. So in the light of that, what do I do? What's the advice that I should take, in protecting myself from excessive tax to the federal government?
Okay.
Thank you, sir.
I get that. So, for proprietorship, like what Mr. Kalu mentioned earlier, is treated as personal. It means that whatever the turnover, once your income is above 800,000 there, which is your turnover, it means whatever money is entered with turnover is above 800,000 naira, then you'll be exposed to tax. But for the limited liability company, you have a threshold of 25 million before you begin to tax. It begins to be applied. You have that threshold of 25 million before you. So as a small company, so the best way is for you to do more transactions in your limited liability company relative to your personal account, because you pay the personal account, you pay more tax in your personal account using that for your business, because you qualify faster in your personal name compared to your business.
Yeah, hope that makes sense.
Okay.
All right, perfect.
Thank you. That makes sense.
All right.
Secondly, sir, I have a question. Yeah, I was going through Mr. Carlos' post the other day where he was talking about some of the things to do to reduce the tax you pay to the government, retirement savings, and all of that. Now, for someone who has a limited liability company, is it also right for me to do some of these things in my personal name? What do you advise them?
No, so I think that in some of the ways that you would see to avoid it, you will see people creating subsidiaries. So if you know that you have a threshold of 25 million, your business, and you're almost approaching that, some people may create another subsidiary and say, okay, this is what they do to also have another business running that. They know it's complex. You can't continue to be creating companies. Even those that you are dealing with will be suspecting you. So it's not that straightforward. You deal in company A today and they say tomorrow is company B, next tomorrow is company C. So it's not that easy, but that's the way, one way, if it's not something that happens frequently, to at least reduce what you would pay.
Okay. Because all those things are, again, I'm just going to hold up my board, my high-tech board, on how to reduce taxes. Let me just go over them once again. How to reduce your taxes. Number one, pension funds. You've got to open up a retirement savings account. Retirement savings account is going to be 18%. That's what the law says is totally 18%. 8% from you, 10% from your company. But the law allows you to make additional voluntary contribution. If you have a very, very good advisor, you can make your additional voluntary contribution to reduce your taxable income. Number two is life insurance for yourself and your spouse. The premium you pay is written off your income. That reduces your taxable income. Number three is National Housing Fund. There's a minimum amount specified. There's no maximum. If you're trying to buy a house, contribute to NHF, is tax deductible, then use those funds and add to your PFA 20-30% that they've approved and buy a house. I think 25% for PFAs, then buy a house. NHI has National Health Insurance Scheme. You contribute to that health insurance scheme, you also do not pay a tax on what you contribute. It reduces your taxable income. Rent, if you pay rent, 20% of your rental is given to you as a tax break, up to a maximum cap of 500,000. Then finally, interest on mortgage. If you have a mortgage, you are paying interest, you can claim that interest to reduce your taxable income. The whole point is to reduce your taxable income. What most people are doing on social media is simply taking the income and applying to the tax table. That's the wrong way to do it. You've got to, first of all, get your total income, all earned and unearned income. So salary, royalties, crypto, everything that is income, you put it, then you apply deductions, top of the line. You apply your top of the line deductions. Whatever you have left over is what you then take to your tax table. Even with the 800 starts after your deductions, not before. So you don't say if you earn 10 million, for instance, and just example, if you earn 10 million and for instance, you take 9 million and you put your retirement savings account, your income is now 1 million, according to the tax authority, which means you're only going to pay tax on 200,000, not 10 million. Hope that makes sense, right? That's how you want to do it, not the direct allocation. All right, let's get Tony Anthony. Tony Anthony.
Yeah. Thanks, Carlo. I appreciate you guys. I have a quick question. I'm not sure if maybe it has been answered because I joined a little bit late. But my question is coming from the bond aspect with regards to tax. So the savings bond, I invest in savings bond. I also invest in Sukuk, all the ones that have been rolled out. So one of the summary of the offer and status, it says that it qualifies as government security within the meaning of company income tax and personal income tax for exemption. So my question is this: will there be a personal income tax being taxed on this income gotten from savings bond?
Yes. First of all, there will be no withholding tax if you are investing your personal income. So we looked at that. But if the income you are making or you have made is above 800,000, then personal income tax does to set it. Because that looks at your annual income.
Yeah, but it's saying qualifies for tax exemption for personal income tax.
So Ayo, what if he earns 10 million and he buys 5 million naira bond, what's his taxable income?
If he earns 10 million, it's going to be graduated because the income, from the way I understand, the income will be taxed for personal income tax. But you'll be exempted from withholding tax.
No, see, so let's say I work for a bank in Nigeria and I earn 10 million naira for the year. Mm-hmm. And after the tax has been deducted, what comes back to me is 10 million naira. I take that 10 million naira and I buy savings bond.
Yeah, that's what he's answering you. He's saying that you will not pay interest, you will not pay withholding tax on the bond. Yeah. So if you've already paid your tax, then that's the same thing you are saying. There's no before or after. Just when you buy the savings bond itself, you don't pay the tax on the bond itself, on the bond itself. But your personal income tax is the different thing entirely. So you'll still be on that tax table. The only way, look at it this way, let's just make it clearer. The only way you reduce your taxable income are those 5 things I listed, apart from rent. Rent is a separate one. The only way you reduce your taxable income, many people are confusing taxable income with income. They are 2 different things. To reduce your taxable income, you only have number 1, RSA, number 2, life insurance, number 3, National Housing Fund, number 4, National Health Insurance Scheme, number 5, interest on mortgage. The rent is like if you pay rent, you get 20% of the rent paid, capped at 500,000. Those are the only ways you reduce your taxable income. So any other way you are doing, any other scheme you have in mind, it will not reduce your taxable income. It will reduce the tax you pay on that activity. So for instance, if government says if you wash a car and you pay the car washer 10,000 naira, we will not charge you tax. Fine. That means you can reduce your taxable income or limit your taxable income. But when you pay for that car washer, man, that 10K, fine, will not tax you on it. It doesn't affect your taxable income. You follow the point, sir? Your taxable income can only be reduced by those 5 items. Apart from that, you will simply not pay a tax. Does not affect your taxable income. 2 very different things, sir. You get?
Yeah, I do. Thanks a lot. Appreciate it.
Perfect, sir. Let's get Mba Ifenacho.
Good evening, Kalu.
How you doing, sir?
Please, I'm doing fine. Please, I have been following you, and I have a very big problem with all this tax issue, and I want to ask. We're into agriculture, manufacturing, processing, and pure farming. And, our turnover is high. I don't understand. I don't know. Is there any way, are they taxing us in our turnover or our net profits?
Good question. Nobody knows.
If they tax us on our turnover a week is above what they are saying that is tax-free.
Yeah.
We are trading, I'm using the business name, but in a week we can do above 50 million turnover.
Yeah.
More than.
Yeah.
So if they are, so I'm coming now, and we also use bank loans from different banks, from Bank of Industry, Fidelity, and other. Now, how are we going to reduce our tax? Because since you guys have been talking, you are in bonds, and we are not actually close to that.
That's for private guys. Honestly,
we are into where we turn money regularly. So in a year you'll be doing in billions. So how are we going to reduce it? Because if they tax us all this thing you are saying, we'll shut down.
No. So the way it's done is that, first of all, if your turnover, like for your company now, you will be classified as a large company, it's above 100 million turnover for the year. But there are also some tax exemptions that you now enjoy. So part of what is in that new law, on the new tax law, is that if you're a new company in the agri space, there's the income tax. For a corporate company, there's corporate income tax, which is 30% for large companies. But it is after, it is not on turnover. The turnover is to first qualify you. So when we look at turnover, we'll say you're a large company because it's above 100 million. But there are some exemptions that you will not get. There's for capital expenditure, for instance, that they would trying to encourage people to invest. So when you bring in things, you'll be getting tax credits because you won't pay tax on that. Then when you're just starting, they exempt you for tax for the first 5 years of your business to encourage you to continue to grow. So there are list of exemptions that applies to you. So not just about the income, but it's going to be based, whatever tax that will apply even in the future is going to be based on your net. So, their expenses, there are some allowable expenses. So up to a certain amount because they know people can misuse it. So those expenses will be deducted first from your turnover. When you look at the balance sheet, the way it's constructed, your turnover, there's your cost of sales. On those cost of sales, the VAT withholding tax that might have been paid because you're a large company, you pay your VAT on some of the goods that you've already bought. And that will give you your gross profits. Then other taxes, your OPEX, those are liable, they check it. Then at the end of the day, your profits will now be applied by the time they will now apply 30% because you're a large company to that. So most times is for you to now see whether to enjoy tax credit, do you want to invest more in capital expenditure? Because there's a relief that also comes from it. So you will also need to look at that to reduce the tax that you will pay. But if you are just starting, if you are less than 5 years, I think government is trying to encourage business just starting. So you may not be eligible to begin to pay tax for the first 5 years.
We're up to 10 years.
And again, honestly speaking, businesses have more ways to reduce their taxable income than private people. I mean, it's even for me, sir, if you just hire an accountant, I don't start telling you on social media, if you just hire an accountant, they will tell you how to restructure your business. I mean, you have more allowances than the private guy. Private guy just have these 5 items I've listed. For the business, literally your cost of production are allowable. Any cost you make, you say you are into trading, the cost of sales for you are allowable. You will not pay tax on cost of sales. Any expense you make towards making profit for your business is allowable. Any expense.
Okay.
So you're going to pay a tax, but they are telling you that if you buy a generator, that cost of diesel, you write it off your business. And that generator is what you're using to make a profit. If you have a building, that building is where you use your warehouse for your goods, you write it off. The rental for that building, you write it off. If you use a GSM phone, you write it off. If you go and have lunch and you are discussing business plans with you write it off. You fly on an aeroplane to go and buy goods from Calabar, you write it off. So they are saying as long as the expense is targeted or directed towards generation of profits for this business, you can write it off. The private guys don't get this, don't get this allowances. So what I would say, sir, go and hire an accountant. Let them look at what you are doing today and say, what do we need to change from today till December to get us in line with the new pension plan? That's what I'm doing, sir. I'm not supporting the tax. I'm not against the tax, but I'm saying we can't be arguing or fighting. We have to create conditions in our companies to survive the tax. That's why I'm doing what I'm doing. If you came to me and you asked me this question, I'll charge a lot of money. Same to Mr. Ayo, but we're here talking so you can pick all these things up. And so go, sir, go get a chartered accountant, talk to your company. They will give you the part. You'll be shocked at the allowance that you have. Yes, sir. So please, don't wait. Don't wait and argue. Don't be online. No, just go and talk to a professional. What can I do? And they'll tell you. You'll be shocked.
Thank you.
Yes, sir. Please, Mr. Mba. Yes, sir.
Thank you so much.
You're very welcome.
Thank
yes,
you,
sir.
Thank you.
All right, perfect. Let's get Ikechukwu. And Ikechukwu has spoken. Ikechukwu Korea. Have you spoken?
I have not. Sir.
Please go ahead, sir.
Good evening. Good evening, sir.
Yes, sir. Go ahead.
Okay, please. Like on this personal income tax, as a salesman, normally my company will deduct my tax before sending whatever it is left to my salary account. Yeah. Now, as a salesman, I still use that same account like as a transit for other people that want to pay the company, probably to gather the money, before giving to the office. So now I can, if in a month, you can even see sometimes 16 to 18 million turnover in that account. So my question is now, after the office would have deducted my tax and my account is more or less like a transit point for monies that goes to the office, would that money be taxed at the end of the year? Because at the end of the year, I think it does over 100 million. So would that be taxed? And then how can I probably look at stopping that, so to say?
Yeah.
Thank you.
It will be,
it's a bit taxed. So
this rule is for people like you.
Yeah.
That we want, let the company open a company account and let the businesses, the inflow, go there.
Yeah, exactly.
At the end of the day, you'll be at a loss by the time they slam you with the tax.
Correct.
So from next year, this should not even be encouraged, because you are putting yourself in a very tight situation. By the time they at the end of the year, they tax your account. Nobody wants, you can't explain to the tax man that it's not your money. It came into your account. They turn over.
Yeah.
And the tax will apply because it's more than 800,000. So you'll be paying almost 30% or 35% based on the maximum.
Okay, we spoke about this yesterday, or when we had about nearly 4 hours on taxes. So Ike, you could look at it this way. I explained to people, number one, no more, don't pay into your account anything not for you, for your own income. If you work for somebody, only pay your money into your own account. Let's say you work for, like, a commission guy, maybe you work for 5 people, and then you have your own personal account. I even advised yesterday, if you can't open a company account and open a company with a company account, open maybe 3 personal accounts. Use one account for your runnings. Oh, I'm going here, running. That's your business account. It's a personal account too, but it's a runnings account. Then have your own personal account. So from that runnings account, you will narrate and say, salary to Kalu, you pay yourself every month or every week or every time you want. Salary to Kalu. So it goes to your salary account. All your phone bills, all your other things, leave it in that transaction account. It's not the best. It's not a business account, but it's better than commingling. What you're doing is called commingling. You are taking money from your employer. You are taking money from customers. You are commingling. To the tax man, that money is your own, because that account is in your name. So what will happen to you that you are going to go up the income tax ladder? They will put you as paying the same tax as Dangote. That's what's going to happen to you. So you want to stop it immediately. You don't want to collect anybody. If let your company open a business account and make you a signer. So you can tell people, pay to this account. It's for your business company, but you're a signer on the account. It's not your money, it's a signer. That's the way they want to do it, sir. Yeah? So no more.
Yeah, sir. There is actually, the company actually has a business account, but for those that are into sales, and maybe they might get better. What I'm trying to say.
Ikechukwu, just advice is don't do it. This is not even anything that is not for you. Don't pay to your account. Your friend says, I beg, I get one check. Let me cash them to your account. Don't do it. Anything that is not for you, do not pay to your account going forward. Anything.
So now it does mean that if there are other side hustles that come and it has to go through your account, aside those your salary and whatever that comes from the office, those other ones, you have to pay tax for it if it's above the 800.
Ikechukwu, don't complicate this thing, no. Whether it's 800, what we're saying is this. When the taxman does not have time to ask you questions. They do what they call best of judgment. If I'm a taxman and I see your account has 1 million, I'll tax you 100,000. It's left for you to come and explain to me that 1 million is for my auntie, for my cousin, for the salesman. That's your business. I have charged you 100,000. You see what I'm saying? They don't have the time to come and be asking you, okay, what about this one? So you want to avoid best of judgment. You say, okay, if I'm doing other runs, like I said, have 2 accounts. Have one account for your runnings, for your business here and there. Have your own personal account. At least if they tax, you can go and say, Mr. Taxman, I have 2 accounts. This is my runnings account. This is my personal account. You see, I pay myself salary. It's not 100% that they will agree with you, but it's better than you taking money from people and paying to your personal account. You will pay tax on that money. While warning you, just giving you fair warning. Don't do it, and it's not the best. You don't do it at all, right? And it's just try not to move away from that. So yeah, all good. All right, let's get Supreme. Supreme, how you doing, Supreme Young? Supreme. Is he available? Let's get Femi Elafris.
Elafris.
Hey, how you doing,
Elafris,
Femi?
thank you. Good evening, Kalu.
How you doing, my brother? Hi, what's happening?
Yeah, thanks for this space. So
hey, my
I have
guest.
a
Wow.
yeah,
Go ahead.
can you hear me?
I can hear you, sir.
Okay, so my questions are quite a lot, but let me start with this. Okay, number one, I run a food business, and I already pay value-added tax inclusive because I can't do exclusive, so I did do inclusive value-added tax. So if I'm paying VAT already, so at the end of the year, why am I still paying CIT? Despite that, the money I got is the money for my sales is what I saved to pay VAT. So why am I still paying company income tax? Yeah. Or is there an exemption for people who sell those kind of goods? That is basically all I do. The reason I do is sell food.
They are different now. VAT is not personal income tax. There's different things now. That's why.
Right.
And but now they're giving you VAT. You can claim VAT input now. So in this new tax law now, you can claim your VAT that you paid. There's VAT input. You can claim it now. But apart from that, VAT is different from personal income tax. VAT is a tax on consumption. So when you buy your tomato, you pay VAT to that person. Then when you sell your goods, you charge that person VAT. That's the law, right? But now you can also claim your VAT input. But VAT is different from personal income tax. So as a company, you still pay your corporate income tax. As a person, you pay your personal income tax. The company VAT is just on the consumption that's occurring between you, your suppliers, and your consumers. Yeah.
Okay. So okay, thank you for that. Now, my second question now is this. Let's say, okay, I work and I get my salary, and my employer has already removed the pay tax. Hello?
Yeah, thanks for reminding me of that. Okay. I was going to ask Mr. Ayo that. Do you mind me asking Mr. Ayo this question? Mr. Ayo, yesterday something came up, and I was saying that in the past, when you pay when you earn a salary, you get an automatic exemption, 20% of your payroll. And because of this reason, that's why many companies were paying taxes for their employees, because the company is the one paying your salary. So the company simply applies 20% on your paycheck and then files tax for you. With this new tax law, they are asking the individual to go out himself and buy RSA or buy life insurance or buy NHIS. So what does that mean? Does that mean that the individual would not have to self-file? That will I have to file my own taxes to claim those above the line deductions? Or will the company still file? Like in your own company, how are you guys going to do it? Are you saying you're going to file, if I do life insurance, I tell you, then you deduct it from the tax you're going to pay for me? Can you speak on that?
Yeah. So how it's done, yes, because only applies in most companies, you will inform them, let's assume there's the voluntary contribution you are making pension. That means you are paying higher than the normal one. It would have been factored in when they are calculating your tax. And maybe you have some insurance premium that you are doing, life insurance, the NHS. So that's the HR would have calculated that, so that the payee that will be paid would have factored that. That means it will reduce. So it's not something you have to go back to claim. So I know for most people that work in very standard organization, you inform them, you give them evidence that this is what they may even be remitting, that they are deducting it on your behalf, that they are paying it, or at the end of the year, you give it to them, because what they would do in my company is that at the end of the year, they would help work with the tax authority for, you have been remitting on a yearly basis, then if you have some things that maybe you need to exempt, work on that to get your tax clearance for you. You have to go to the portal, you complete based on other income that you are paying, and you get cleared out at that point. So it's either way for the best way is that to inform your company if those things that are exempt, the additional pension, voluntary pension, that if you want to add more to it, the NHS, that's the National Housing Fund, the life insurance, some of those things, they factor that in so that you don't have to start claiming tax at the end of the day.
Okay.
You would have paid.
All right, just want to make sure I got that clarification. So please go ahead, Femi, go ahead. And Mr. Ayo is going to go very soon. He's already up against the clock, so we'll try to get maybe one or two. Then we'll let him go, and then I'll keep the space for him. But go ahead, Femi.
Okay, all right. So my company, the company I work for, has deducted my pay tax, and let's say my wife sends me maybe like 500,000 or 700,000 to get some things from the market, or I send my friend money. So will those money still be taxed? That is the next question.
We get this question, Mr. I got this question over and over.
Yes. At the end of the day, so you have paid the tax based on the other income. So now they will now look at other incomes that are coming in. So imagine that because you have paid tax, someone is sending you 20 million, 30 million, and you are not paying tax on. So they would see. So first of all, is the threshold. You already qualified to pay tax. They will not confirm, are you paying the right amount of tax that you should pay? Or they are so they see.
But I think I think this question has been.
Sorry to cut you. Can you hear me?
Yes, we can hear you.
Okay, sorry to cut you. Okay, now remember, I've paid my own tax payee. My wife has paid her own tax payee too. And then for my own salary that has been taxed already, I'm sending my wife money to go to the markets. Say maybe 500,000 or 600,000, which is already above the threshold. With that money I sent to her, is it still going to be taxed?
It depends on how it is viewed. Look at it. There's no yes or no answer. Look at what's going to happen. If I receive 1 billion naira into my account, maybe Dangote sent me 1 billion naira to say, this money, give it to my friend down the road. The taxman has seized that 1 billion, right? The money is not my income. The money was money from Dangote to give somebody, right? The taxman will be expecting me to pay tax on 1 billion. That's the expectation, that I will pay tax on 1 billion. Let's say I don't pay tax on I pay tax of 10,000. They'll write me audit and say, hey, you got 1 billion, you didn't pay tax. I have to have the paperwork to show the tax. Now, this money came from Dangote to pay for this, and I then took the money and give Dangote. Then I'm fine. The point I'm making is that all these questions are hypotheticals. I did this. What the tax people are saying is this: why, if you give somebody money of 500,000, it triggers them to investigate and say, what is this man's income? Did he pay tax for 500,000? It doesn't mean you pay tax on 500, but it now triggers them to look at you carefully and say, okay, you are going for summer in Greece. You are importing container. You drive 2 SUVs, but you are paying tax of 10,000. You see the point I'm making? You can explain, you can say, oh, no. I'm a cooperative chairman in my village. So every year, everybody in Lagos will pay to my account. Then I take that money and I send to my village for them to build a road. That's a perfectly good example, reason. But you've got to have the paperwork that when they come to audit you can say, no, this is what I'm doing. No, they'll say, okay, don't do it again. So there's no will you or will you not or will it? No, the point is, don't do it to start with. If you then do it, make sure it's narrated. If I send money for housing upkeep to wife, I send to her. It shows up on the bank. You know, if you go to your transfer, many people don't do transfer narration in Nigeria. We just transfer money. We don't put narration. Now start putting narration. Transfer to wife for upkeep. Put it in narration. You receive money from your brother in America to buy you fish and send to Canada. Transfer from my brother to buy stockfish. You have to do it. If you go to a bank in America and you say you want to withdraw 11,000, what do they ask you? What's the money for? Your own money, Abi. They'll ask you, what's the money for? Abi? They'll ask you. And you have to you say, oh, it's for family support. They'll write it there, family support. Your own money. So that's the same thing we're bringing here. So try to remove the appearance of transactions occurring beyond your income level. And if transactions occur beyond your income level, have a reasonable explanation with numbers to back it up.
That's okay. Then, so my last question is this. Hello, can you hear me?
Yes.
Okay, thank you. So my last question what was the question again?
Sorry, I can let you stay here. I can let Mr. Ayo go. Once you can come back up. I've kept Mr. Ayo for. I had a deal with him to keep me here for 2 hours. We are way past 2 hours and 10 minutes. So, sir, I will keep the space open. I think I'll try to, maybe we'll try to stay we're usually here for 3 hours, but I just want to make sure I honor my time with you, Mr. Ayo. Just want to thank you for coming. I know I've personally learned just from the few nuggets you've shared. I don't think it's the last time we'll call you. I think there are lots of questions about these new taxes, also about the economy that needs to be addressed by someone with your caliber and, of course, credentials. Thank you again. And I just want to honor you for coming, and also congratulate you for getting your doctorate. You are very humble, sir. You try not to blow your trumpet, but I just want to commend you, sir, and also thank you for coming. So thank you so much. It's supposed to be open. I'll try to take the questions. Just want to say thank you for honoring the invitation at very, very short notice.
It's always my pleasure to be here.
Yes, sir.
I hope you learn a lot from all your posts. Thank you so much.
Thank you, sir.
Welcome.
Yes, I appreciate it. Yes, sir. All right, fantastic. So, guys, we're here. We'll try to be here till for the next hour. We're at 49 minutes. So, Femi, Femi, did you get your last question, or you want to ask another?
Yes, I have my last question now.
Go ahead.
So, when you're speaking, you said something about new companies or new businesses that are just starting have a 5-year exemption. So, does that also apply to business name, or just limited liabilities, or just companies?
I think this is for companies, no business name at all. Business name is personal. So if you're doing business name, it's going to be personal for everything. So it is going to be for companies, correct? Business.
Okay,
business name,
thank you.
You're welcome, sir. Thank you so much. Let's get Malam. Femi, thank you. Malam, how you doing?
Good morning, good afternoon, Mr. Kalu. Thank you.
How you doing?
You're fine. You have been trying to educate a lot of issues here, but I have one major concern concerning this tax. For me, I don't think there is not that much difference from what we are having before. But my major concern that I'm looking for this tax reform, the whole issue is how effective it can be in terms of collections and all that, because that is the major challenge. And I don't know how this new tax law have addressed that.
Collections, you mean? Collections, right?
Yeah, the collection, how effective those who are not supposed to pay tax are not paying. How can these laws now cover that, so that they will pay? And another issue, I don't know how this tax law, I don't know whether you can explain to me how this tax law cover this issue. For example, I just buy suya now. And the suya man, he killed almost 2 rams a day or 3 rams a day. At the end of the year, definitely, I know with the volume of his transactions, definitely he has to pay tax. But guess what is happening? If you come to buy suya of 2,000, 3,000, 5,000, if you say you want to transfer, say no, I don't collect transfer cash. Okay, where is the cash now? Okay, POS guys is here. You collect the money from the cash, you give him. So he too also, if you want to go and buy those rams and other things, they don't collect their transfer. You give them cash. So the volume of transaction that he is doing everything, if you calculate it, more millions. So how, I don't know. And there are more businesses, informal businesses like this, and which I think is the major concern, and I don't know how we are going to solve this issue.
Okay.
So that.
Yeah. So let me just. No.
I mean the general economy.
Let's just do two, because we have to get people. So real quick, right? Real quick, Malam. This is the major tax reform, major, and there's a huge difference with this law and what we used to have in the past. The biggest one, which most people are not getting, and I'm repeating myself over and over again. In the old law, if you earn a salary, once you get a paycheck, automatically you get 20% of that paycheck as allowance. So if you earn 1 million naira a month, every month automatically, you don't have to do anything. The government will give you 200,000 from that paycheck as allowance. That means you don't pay tax on 200,000 automatically. With this new law, you don't get 20% automatic. You have to go out and buy those investments that reduce your taxable income. What that means is that if you earn 1 million under the old scheme and you earn 1 million under this new scheme, with the old scheme, you get 200,000 naira automatic. With this new scheme, you have to go and buy pension or life insurance or NHIS or NFP or pay rent or pay insurance to get that same 20%. So many people are going to be shocked in January that are going to wake up and be like, my taxes have gone up. Yes, because you don't have an RSA or you don't have housing fund, your tax will go up because your taxable income is going to go up. So that's the major change I have seen. Not the one people are on social media saying bank account, but this one. Because many people don't have RSA, many people don't have NHF, many people are not paying for homes. So they're going to get hit with a higher tax. This is not the tax rate we're talking about. The taxable income will increase for many people in 2026 because they do not have the outlets to go and reduce them. And it's those outlets are still available today, but people are not understanding that you have from now till December to go and buy those outlets. That's a very, very big change. You can disagree if you see you thumbing down, but that is the fact. Number two, you talk about the guy buying RAM with POS and cash. Taxation is done, number one, to do revenues, and number two, to change behavior. The government is saying that cash transactions cannot be traceable. So for national security and for revenues, we don't want to have cash transactions. So you are going to see that all that cash you are doing, that POS guy, remember what did CBN say? Geolocate that POS. They're going to geolocate the POS. He cannot get money from the bank unless he's paying tax. His NIN or his BVN will be captured. So when he's trying to get cash from the bank, they know how much cash he's getting. They will hit that guy with a 1 billion naira best of judgment. He's going to want to tell you, I don't take cash anymore. Cash is not illegal. But once you collect cash and you don't file taxes, the taxman will hit you with a big fine. So you saw that social media kid, right, that was hit with 36 million. Why did they hit him with 36 million? Because he hasn't filed taxes. So the taxman said, okay, we are seeing you riding a 4x4 Jeep. You are using iPhone 6. You are tweeting this, tweeting that. We're going to tax you. You now come and tell us that you didn't make that money, so I will remove the tax from you. If you do a rap song, you say, I earn 10 million a week. They will tax you for 10 million a week. You have to come to assess yourself, file a tax to reduce that tax. So that's the thing. They are very organized, Malam, this time. They are very, very organized. Do not nobody say, oh, I see many questions. What if I do? What if I? The people you are talking to, Mr. Idole, how many years of tax does he have? He is in the private sector. He is the one that was advising the private sector how to avoid taxes. So remember, hear what I'm telling you. The guy that has written this tax code, his former job was advising private sector how to avoid taxes. He's not the one come to tax you. So what are you going to hide that he doesn't know about? Where would you pass doesn't know about? So that's why I said I advise you, try to reduce your taxable income, which is tax avoidance, which is legal, rather than trying to evade tax, which is illegal. They will catch you. I'm just telling you, my job is to talk money. So Malam, good question. Let's get Ohaifo. I'm saying that right. Ohaifo.
I've been here for so long. Thank you very much.
Everybody will speak.
Kalu.
Everybody will speak. I do apologize. Everybody will speak. No worries. Everybody will speak. Yeah. Ohaifo, please go ahead.
Yeah, thank you. I am enjoying this discourse. So the question I have is for religious bodies.
Yeah.
Religious bodies, churches.
Yeah.
So people, they receive donations, they receive alms, they receive tithes, all manner of goodwill support come in. And I don't know, because sometimes some pastors use personal accounts to receive money.
They will pay tax.
So should the churches go and will churches become limited liability companies or
many are already? Many churches are arrested as limited liability companies. Many of them already are. So you see God's Church, but the actual business name is God's Church Limited or God's Church, whatever. Many of them are licensed to do business. Many of them are licensed as incorporated trustees and all that. But what I think I understand is this. I'm not an expert in this. If you have a charity and someone gives you donations, you don't pay tax on a donation. But if the charity then sets up a private business to earn income, the private business will pay tax unless the private business is sending all its money back to the charity. So look at it this way. If Kalu's church owns an airline, and that airline makes a profit of $1 billion, FIRS will tax the airline. The only way the airline can reduce its taxes is to send that whole $1 billion back to Kalu's church and say it is making a donation back to Kalu's church. Just like how the Catholic Church operates. Catholic Church have many private sector business. They have property, they have schools. But you know that the profit from those schools goes back to the church for them to do more buildings and all that. So it has to be a loop. You can't have a church that will then own a bank and say, because it's a church and a bank, we don't want to pay VAT. No. So as long as you don't put the money back to charity, you'll get taxed on that money. Yeah. Make sense?
Yeah, but I was asking, thanks for the answer. Very, 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 very comprehensive. I was asking about donations now to church, not church investment.
Those are charitable donations, exactly. So the church is receiving donations. Again, the church has to regularize. If you have a church under limited, how do you classify that donation? Is it going to be income or tax or charitable donations? Most times the church will file those as charitable donations, which means they're not going to pay tax. In America, when you pay your tithes, they will give you tax ID. When you pay tithes in America, you have to get your tax ID. Then when you file your taxes, you say, I paid tithes. You reduce it from your taxable income in America. I believe the same is going to happen in Nigeria. So when you pay those tithes, you are donating. That's why many pastors in UK, remember in UK, Nigerian pastors get into trouble in the UK because we go to the UK and receive donation and go and buy Rolls Royce. They will say, well, you're using a charitable donation to live your personal life. This is illegal. So in the UK, you can't do that. In Nigeria, they've been doing it. So we have to sort of classify what those transactions and donations are. And it's going to come, I'm sure, pretty soon in the clarification of this tax law. But that's where we are on that. All right, let's get Ola. Ola, how are you doing? Thanks for waiting, Ola. I appreciate you. Ola? Ola, I'm calling you, sir. Yeah, hi. Hey, Ola, how are you doing? Okay, what's up?
Yeah, I'm good. You?
Very well, sir. Thanks so much for asking.
Just a quick question. For a landlord that is receiving rental proceeds,
yes, sir,
into his personal account or company account and limited liability company,
yes,
do you still get tax if you take those money out and buy dividend or you buy?
Yeah. So hi, set your kid there. Yeah. If you earn rental income, it's income, so you're going to be taxed, whether on the private side, on the personal side. You'll get taxed either way because it's income, like you said. Yeah. Mm-hmm.
So, but if I use the proceed to purchase stocks or treasury bill, will I still get taxed for that?
Yes. Remember what he clarified. Your income is still going to be taxed. What you're not going to be taxed on is the withholding tax on the treasury bill. So that is not an income tax. You still get taxed on the income tax side, but the treasury bill instrument itself, if it pays you any tax, you will not pay. You see the differentiation. Okay. If you take that rental money and you buy treasury bill, you will not pay the withholding tax on the treasury bill. But the income that is flowing back to you, that income used to buy, that's income that has taken you up on the tax sheet that are going to then pay tax on. Yeah.
So it's going to be 10%, right?
10% of what?
Of the proceed that comes in from the renter.
No. Your income is based on the tax table. The treasury bill, you will not pay withholding tax at all.
Yeah, I understand the treasury bill part. That's fine. I'm just saying about the rental, the money that comes in that you collect.
No, the rental goes to your income, which will then be applied on the tax table. So if you get 10. It's a simple question you're asking me, sir. There's a table for your income tax. Based on your rent, it takes your income on that table and you pay tax according to that table. I can share it again if you want. The tax table is what you're going to pay tax on. Rental income is just income. You follow?
All right. Thank you so much, Kalu.
If you want, I'll share the table again for you. Just the tax. I just put it on Twitter. I just share the tax table again for you. So for instance, let me go to your tax table. So if you earn, for instance, let's say you only income you earn is rental and you earn 2 million naira rental. If you deduct that first 800,000, right, it's 0%. So you now have about 1.2, right? That 1.2 is going to be at 15%. You follow? The first tax bracket is 800,000 at 0%. After that, you have 2.2 million at 15%. 2.2 million. So any rental you make up to 2.2 million, when you deduct the 800,000, the leftover will be charged to you on a personal basis at 15%. I assume there are no deductions and anything else at 15%. So, yeah.
Yeah. Sorry, Kalu, just a quick one. I've done so much reading on this, and what I found out was if you put that money in your company's account, if you get that rent proceed into your company's account, you only pay 10% withholding tax, and that's you don't have to file anything, and that's all.
That's so income tax for personal is going to be 800,000, for company turnover of 50 million, right? So if your rental is less than 50 million, you don't pay the tax. Yes, both. So it's personal and corporate.
Yeah, on that less than 50 million where you don't pay tax. So they went further saying that when it's time for you to now withdraw that money, either you go by paying yourself as a dividend or by a form of salary, they will still tax you on it.
Yes, because you are working for the company. So if you take money from the company to yourself, the question is, are you paying yourself more than 800,000 a year? If you pay yourself 2 million a year, you will go back to the table. You will then take 0% on the first 800,000. The balance you will pay 15%. That's what I'm saying.
Yeah, you're right, Carlos.
The company,
so it doesn't matter what I use the money I withdraw from myself from my company accounts. It doesn't matter what I use it for, either for stock or treasure bill, they will still tax me.
They will tax you on income.
Yeah.
On income. So if you buy the property with your company name, the company will not pay tax if the total turnover is less than 50. If you don't pay yourself a salary, then you don't pay any tax. But once you pay yourself a salary, then they will tax you on that personal income tax. Make sense?
Yeah, it makes sense.
All right,
Thank you
perfect.
so much.
Excellent. Thank you so much, Ola. And let's get Mr. Kolade.
Thank you so much, my brother. This is like the information that is coming out of your space is highly appreciated and highly educative. So now this is my question. This is it. For someone in diaspora would send, let's say, average 1.5 million every month, like to his own account. He doesn't work in Nigeria. He just send it to his own account, and from there he just distribute like to support family and friends, like to help them out. So what happened to such person who is in the diaspora? Number one. Number two, this the deduction, is it an automatic deduction, or are people giving the opportunity to, like, the way they do it out of the country, where you put in your information, like how much you earn, what you expend, and at the end of the day, they will tell you this is how much refund you are qualified for, or this is how much you are owing the government. So how do they plan to do this? Is it just an automatic deduction at the end of the year? They just say, oh, these accounts, so amount came in, we remove this amount, or we're going to, how do they plan doing it? And the last question, do they have a room for guys like you, like having to now build like maybe applications that can help people to do this in a simplified manner? Just ask them question, they fill in the question, and automatically is submitted on their behalf to the government. You make your money, you help them file and do things, and if they have a refund, they get it. If they don't, all fine and good. Those are the three questions I have for you.
You have to remind me from the first one. So the first one, you're asking, if you live abroad, you send money home, is the account in your personal name?
Yes, personal name.
Okay, so when you put the money into your account, that's not a tax event. But when the account generates interest, that's a tax event. So yes, you're going to be charged interest on the interest that the account has earned. You pay withholding tax and all that tax on the interest that the account money has earned in the account. Correct. That's what you pay.
Yeah. Okay. Good.
So that's automatic.
So So the second one, automatic, is it? Oh, the second one now, is it just going to be deducted automatically, or people are giving the?
So normally withholding tax is deducted by the bank automatically, right? So when they pay you interest, they deduct withholding tax automatically. So that's easier for that's just how it's done in Nigeria. They'll just go to your account, they pay you interest, they deduct the withholding tax, right? That's all they do. So it's just seamless, more or less. They will not go to your account and deduct money like that. It's the withholding tax that we've been doing already that they will just keep on doing. There is no new. On social media, they will say if you pay 500,000, they'll deduct it. No, if the money goes to an account doesn't bear interest, you don't earn any interest, so there's nothing to deduct. Withholding taxes on the interest you've earned. So let's say I have a current account and the bank does not pay me interest on my current account, and I move to $1 million to my current account. There's no withholding tax, right? I'm not about electronic money transfer. You pay that. VAT, you pay that. I'm just talking about the income, personal income tax side of it. There will be none because you are not earning any interest. But once you earn interest, the bank pays you, the bank withholds.
Okay, thank you.
Then the
third one.
Yeah, on the apps. Yeah. There are lots of people I see. There's a guy I saw 2 weeks ago that had done an app that where you can put in your total income. It's like TurboTax. You put your total income to calculate your total and all that. He did it. I will try to get him, bring him back to a space so he can explain and all that. What this tax thing is going to spoil is a lot of fintechs are going to come up with these tax calculators and how you can avoid taxes and all that. Yesterday, I asked people, all of you, most of Nigerians have money with savings app. There are many savings app out there. There are many loan app out there. Start to demand that those people put a tax calculator on that savings app or that loans app. It's not hard to buy. They are off the shelf tax calculators you can just bring in, change the currency to Naira, put in the assumptions, and to do that for you. So those guys should be able to do that service for you. And they're very big, they make a lot of money. So start to demand that I want a tax calculator. Even if not a tax calculator, tell me that if I invest $1 million with this savings app, what is my potential tax I will pay when I withdraw the money? Demand for that, because if you demand for it, they'll put it in for you. So that's the way you can get that service from them. That's what's going to happen. So you're going to see a lot of fintech people are going to bring up apps. There's going to be a TurboTax, I'm sure, in Nigeria very soon. Someone's going to build one that we can use, connect to our bank accounts, and we'll just file what we make. It will calculate taxes for us and send to Nigerian Revenue Service. Nigerian Revenue Service has already asked that they prefer online app-based filing. There's actually a wording there in the Nigerian Tax Act that the company should try to use digital online filing. It's already there in the Act. So if you're an entrepreneur, you're an IT guy, this is a big opportunity for you. Yesterday we talked about market women. Market women are going to pay tax once they cross 800,000 naira per annum. How do they know? So a simple app you can build, you say you're going to build an app for a market woman that will be on her phone. And every day the woman will put her total sales on the app. So today she sells 20 naira, she puts 20 naira. Tomorrow she sells 50 naira, 50 naira. That app will just keep on calculating your today's sales and your annual threshold. Today's sales, annual threshold. Once that woman hits 800,000, boom, it triggers and says, hey, madam, you are going to pay tax, so go and see a consultant. And you can link that app to consultants that have paid on the app. So if I'm a consultant, I register with the app. They will say, where do you live? Madam, where do you live in K2? Oh, there's a guy in K2, go and see him. She will come to me and say, okay, you've passed 800,000. Let's reduce your taxes. Do you have RSC? Do you have NHF? Blah, blah, blah. I work with her to bring back her taxable revenues to below the number. That's what's going to happen. So it's going to create jobs. It's going to create expertise. And that's where we're going. This is just the first draft. They're going to review this thing over and over and over. In America, they're still reviewing their tax acts. They've been collecting taxes for 3 centuries. So this is not the final erudition. It's going to be more and more and more. And we're going to get better in this. Hope that answers your question, yeah?
Yes, you did. Thank you so much.
Perfect. Call Supreme. Let's get Supreme. Supreme Iyang. Yeah, go ahead, Supreme.
Kalu, good evening.
Hi, good evening, sir.
Good evening, all. I just have a few questions for clarification.
Yeah.
You said something about this 800,000.
Yeah.
For a business name, the 800,000, is it profit or turnover?
800,000 is your total income for business name.
Is total income after you less your cost of sales and all expenses.
No, total income. No lesson. So it's not. It's a threshold. It's not a tax table. It's a threshold that qualifies you for the tax table. So if I earn 500,000, go to sleep. Don't worry about this pension information. Just go and sleep. It's not concerning you. If you earn 1,000,000, then you have qualified to pay tax. Then what tax will you pay? You go to the table and say, okay, my first 800,000 is going to be at 0. My next is going to be at 15%. So it's a qualifier. It's not a qualifier for you to pay tax.
Okay, so let's just get this straight. So if I'm running a sole proprietorship now, so it means once my turnover exceeds 800,000,
don't say turnover. I've corrected you, sir. 800,000 is your personal income. Turnover is the company, that's 50 million. Sole prop is 800,000 because it's your name, your personal name. So 800,000.
So it means the 800,000 threshold is the profit.
No, sir.
On that business name.
No, sir. No, sir. Please, sir, listen to me carefully, sir. Listen to me carefully. Okay. When you file taxes, can you mute? When you file taxes with your personal name or with a business name, that means you're filing taxes like a sole proprietor, right? The threshold for you is 800,000 naira personal income because both you and the business are the same. Personal income. If you file taxes with a limited liability company, you are different from the limited liability company, Solomon versus Solomon. So that company's threshold is 50 million. For you, in your income, it's 800,000 naira. Once you cross 800,000 naira, you start to pay tax starting from 15%. Make sense, sir? Supreme, make sense?
Yes, Kalu. Yes, Kalu. So we don't mix this up with the listeners. So for me, as an entrepreneur, when I calculate everything, I know it is still my individual income threshold. So, but for that woman selling pepper outside, how do we get our own 800,000 naira threshold?
She has to file a tax. She has got to go file an assessment. Otherwise, they will charge her 10 million or 1 billion. She has to file and say, I made 500,000. It's self-filing. The taxman has no business chasing you around, though. So one thing Nigerians are going to have to understand is that you've got to file, even if you're going to pay 0, you have to file a tax return. You follow what I'm saying, sir? So that woman selling pepper, that woman selling amala, she's got to file a tax and say, I made 720,000 a year. Based on that filing, you should not pay any tax. You just can't say, oh, my income is 500K, I'm not going to file any tax. No, they will tax you. Do you follow?
Okay, so I get you now. So what I'm saying is this: for those earning salaries, once their salary exceed 800,000 for the year, they'll pay taxes. For those that their salary is less than 800,000 for the year, they don't pay taxes.
Correct.
So for that businesswoman that is selling on the roadside, after all the money she has made, if her total income
no, sir,
is up to
no, sir. So again, you are mixing both of them. Is the woman registered as an individual, sole proprietorship, or as a company?
Like this, the woman here is registered as an individual, as a sole proprietor.
So her total income is what we're interested in. Don't take away, don't bring in cost. Her total income is what we're interested in, not net cost.
Yes, yeah, but you know, before you get her total income, she needs to net out all
No,
her
sir,
expenses.
there is no netting. There is no netting for individuals. You can only reduce your total income by these 5 methods. So the lady in question has to buy RSA, insurance, NHF, NHIS or pay rent or interest on mortgage. That's the only way she can net out her income. Only business can net out expenses. Individuals cannot net out expenses apart from this deduction, sir.
I disagree. Let me explain what I'm saying. Now, for me, that I'm selling biscuits as a sole proprietorship, I'm selling mineral as a sole proprietorship. I buy and sell, I buy and sell. Are you saying that if the threshold of my buying and selling is up to 800, I'll pay tax?
Yes,
or
sir.
After I net up all what I have done?
Sir, you are repeating the same question, and I'm taking my time, not for you, for both people listening. Listen to me, sir, very clearly. When you are a sole proprietorship, you and the business are the same. You are not a business, you are the individual. You just have a business name. So Kalu shop, sole proprietorship, there is no business there. It's me. So the law says that I can only net out my taxes, reduce my taxable income with these 5 things I've listed for you: RSA, insurance, NHF, NHS, interest, and rent. You can't put generator here for me in my business. You can't net off business expense in a business name. No, only in a company name. So if Kalu has Kalu Limited, or that woman saying Akara has Akara Limited, yes, you can net off business expenses. But if that woman saying Akara is Akara in her name, Bola's Akara, in her own personal business name, she cannot net out business expenses. We can only look at her total turnover, i.e., her revenue, her income. Once it crosses 800, we tax her. It's a very simple concept, sir.
So it means you are saying our total revenue, once it exceeds 800,000 naira, she will pay tax.
If she is registered as a sole proprietorship or as an individual, that is correct.
I disagree, please.
That's fine.
I disagree. We may going to look at it again.
Okay, that's fine. That's fine. That's fine. I've shared on Twitter. I've shared the tax rates for you. It's right there. It's from the tax law. Just look at it, sir. That's fine. You can disagree. That's fine. Yes, sir. All right, Mr.
Let me add to that, please. Let me add to that. I'm using enterprises, right? And my tax consultant is saying I'm supposed to be filing VAT every month. Okay. And why I started using enterprise, because I have LLC, but I started using enterprises to avoid paying CIT, education tax, EDT, and what is it called, and then VAT, So now that I'm using that, I thought I'm supposed to pay, while I file this VAT return every month, and then I pay PIT, personal income tax, at the end of the year.
Is that personal or business? Let us go straight to personal or business.
It's a business.
Personal or business? Personal, as i.e. enterprises or limited? Is it a limited liability company?
It's enterprise.
So it's not a limited liability company?
No.
So it's a personal business, correct. Okay, VAT is separate. VAT is not personal income tax. VAT is a tax on consumption. You pay that irrespective, whether you are limited, corporate, PLC, you pay VAT. We're not talking VAT here. VAT is a different animal. We're talking personal income taxes. Now, personal income taxes can only, not my words, only be written off with your qualifying deductions. That means you're going to get your total income, you do your qualifying deductions, you get your net income, your taxable income. It is that taxable income you apply your tax table to. So whatever you want to call it, not VAT, the individual income is what we are interested in. If it's above 800,000, you're going to use that tax table. If it's below 800,000, go to bed. You're fine. Go and pay no tax.
It's above, so I won't have any deductibles in that enterprise.
Why wouldn't you have a deductible? There is no. Is this how? So this is the last time I'm going to say this, because I'm not sure if you guys want to troll me. Look at what I'm telling you. An individual cannot deduct business expenses. Is that clear? An individual cannot deduct business expenses. It's a very simple concept. How are you an individual? If you open a sole prop enterprises, those things are not limited, then you are an individual. So whatever you call it, it's not the turnover. We're asking you, how are you classified in the CAC? So if you have a PLC or limited, right, you can deduct your expenses from that PLC or limited. So you deduct your diesel, you deduct your salaries, you deduct all that stuff from your company. But when you are an individual, your personal name, your enterprises, you can't deduct business expenses. The only thing you can do is to deduct your allowables, which is your pension, NHIS, rent, all those things. That's all you can deduct. You can't go and file a tax return and say, I pay diesel in my house, so I don't want to pay tax. They will laugh at you. You can't do that. You can't deduct on a personal tax return, a business tax return, or even a personal expense that is not listed. I just listed it for you. You can't do that. So I hope it's clear.
Kalu, let me come up here. So our people will learn. VAT is a different thing entirely. Once you pay your VAT, at your purchase, as you are selling, you get VAT, you net it off and pay the balance to the NRS. That is different. What I'm saying here is for sole proprietorship. Sole proprietorship, you don't need to file CAT. Sole proprietorship, I started my business with 10,000 naira in January. I am selling and buying and selling and buying and selling and buying. My total capital is now from 5 million to 7 million. It means I've made profit of, let's say, 2 million. I'm going to pay PIT on that, not CIT, because it is a sole proprietorship. When I less out all my expenses, I'll still prepare my account like
you cannot less out your expenses in a PIT, sir. That's a personal income tax.
Kalu, I'm telling you what is obtainable.
Oh, jeez.
As if you let your cost of sales, your expenses.
What cost of sales, sir? Sir, anybody earning a salary is the same as you. Whether you sell akara or you work in Zenith Bank, if you are filing personal income tax, you cannot net off business expenses, sir. If you want to net off business expenses, you go and register a business. It's a simple concept. I'm not debating your netting off. I'm saying under what classification are you netting off? Personal or business? That's what we're debating here. I'm not debating the rights of. I'm saying if you say you are a private enterprise without incorporation, not a limited liability company, not a public license company, then you cannot write off business expenses to the personal. Let me give you a better example. If you buy and sell crypto in your name and you make a loss, you can only write that crypto off to crypto income. The taxman won't let you take income here and write off here. It doesn't work that way. I'm not sure what you're debating with me about. Go to the tax law and read it. It's clearly stated there. 800,000 qualifies you to pay tax. Now you can deduct your expenses. That's all you can do. You can't deduct, for instance, if you own your own home, you can't deduct rent on your own home. You have to be renting to deduct 20%. So let's move on. If you say you are right, you are right. Let's move on. Let's get Abali, CIA.
Yeah, Kalu, good evening.
How you doing?
Yeah, I'm fine. And you?
Very, very well, sir. I'm doing very well. Thank you so much.
Thanks so much for the insights. I just have one major question. One, I used to run a sole proprietorship. Sometime October last year, I started on an upgrade process on the CAC website, and by February this year, we'll become a limited liability firm. Now, what kind of taxation am I exposed to, and what kind of tax reliefs do I also have? Then, secondly, I had subscription to NHIS. We are on AXA Mansard HMO plan. Does that also qualify us as being part of the NHIS? Because
I
I don't
don't
really understand why I must be on the NHIS or.
Well, they said NHIS, so I don't want to get into the if HMO is NHIS, but the paper here says NHIS. So that's the question you're going to ask the tax guys. They're going to clarify if that means NHIS, but they said NHIS here. That's what they said here. As regards the first question, are you filing as a corporate or as an individual?
No. We've already upgraded to a limited liability firm.
So are you going to file as a limited liability company?
Yes, sure.
So you back out your expenses. Any expense used in the creation of the wealth in your company, you can back it out.
Okay. Office expenses, like currently we have a new branch we're setting up.
Just speak to your accountant. But in broad terms, any expense used in the creation of sales for that company can be backed out. There are going to be, of course, exemptions, limit, and all that. That's going to be what the accountant will tell you. But on a broad level, if you use 10 naira to make 15 naira, the tax law says you can back out 10 naira. In broad terms. So that's broadly for you, sir. So just speak to an accountant who will give you more in-depth details, depreciation, travel, all these questions you're asking. We can't read it in a space, but that's just a broad way you look at it. If you use 10 to make 15, you can back out 10. You pay tax on 5. That's just the way you look at it.
Okay, thank you very much.
You're welcome. Yeah, Simon, how you doing? Simon Obasi, how you doing? Simon going once, Simon going twice. Ivory Clark. Ivory, how you doing? Welcome back.
Yes, thank you very much.
Yeah, what's going on?
This is very interesting. And our guest speaker said something that made me, I have a question. So I live outside of Nigeria and I have been buying for the past 1 year and a bit. I've been buying FGN savings bond every month. It seems he's saying that the coupons I receive will now be considered income, because it's most likely going to be over 800,000 next year, because it's like multiple coupons every month now. So if that means I now have to start paying taxes in Nigeria on that income.
No, I don't think so.
I think you said
you're not a resident,
online,
right?
or I'm not sure how it works. If you have any idea.
You're not a resident. You're not a resident in Nigeria.
I reinvest everything back into the next month's savings bond, or I send it to my brokerage as to buy shares. So I wonder if the reinvestment thing also works for, like, using your coupons to reinvest if you're exempt, if you could be exempt from taxes. Do you have any idea if that's possible?
Yeah, what he was saying. I'm going to mute you because you have a feedback. Yeah, what he was saying is that the instrument is tax exempt, but doesn't exempt you on a personal income tax basis. So you're not resident in Nigeria. So if I'm in America, I'm an American investor and I send $1 billion to buy Nigerian treasury bills, right? What will they tax? They can't tax me. I'm an American. I live in America. They won't tax my personal income tax in America, but they will tax the income I've made from the treasury bill. That's what he's saying, that our withholding tax and all that is tax exempt. So if you're buying the sovereign ones, you don't pay tax. The sovereigns, you don't pay tax because they are giving you a tax exemption. But if you're buying Dangote or you're buying CP, you're going to pay tax on that.
Okay, because the savings bond pays me coupons every.
Yeah, he talked about you have to live a certain amount of days in Nigeria to be termed a resident in Nigeria.
Ah, okay.
He mentioned that. So in this instance, I'm going to have you mute. But just for the feedback. So in this instance, because you are not resident in Nigeria, you're simply going to get the income. That's what he's saying, that is to encourage people to bring money to Nigeria. So they're not going to tax you because you're bringing that investment in Nigeria. It's a tax exempt instrument if it's a sovereign. So the sovereigns are going to pay you going forward less than the other guys that would pay. So if you buy a Nigerian bank bond, different matter, because you then pay the withholding tax on the Nigerian bank bond, on the instrument, but not on your income side, because you're not a resident in Nigeria. You're only going to pay the tax on the instrument you have bought. But the income tax, that's between you and America, because you have to live a certain amount of days in Nigeria to be termed a resident, to be taxed as a resident. Americans tax you irrespective of where you live. If you're an American, you pay tax everywhere. So a good question to have asked is, if you're an American, if you're an American and you buy bonds in Nigeria, do you pay tax on that bond in Nigeria? That's a good question to ask. But go ahead.
All right, that's all. Thank you very much. And one last question, sorry, about someone asked the question about churches and charities. So even if the donations are considered, if they're considered donations and tax-free, does the church or the organization still need to file their taxes?
Yeah.
Even if they're not going to pay any tax on?
Everyone has to file, because you've got to file the donation as donations. Then say, because I'm an incorporated trustee, I will not pay. So everyone will file. Red Cross files a tax return, but then they will file and say, this is our filing. They have an IRS 707 form. They will say, these are the contributors. They will list their contributors. They will list their major contributors. That's why they take your names. Nigeria is going to go there very soon. If you go to an American charity and you give a donation, they give you a receipt. If you go to Goodwill, you go to Red Cross, you do a donation, they give you a receipt, because on their annual report, they will put your name and say, this person gave us money. IRS requests for that. So IRS will say, all this money is in a cycle. It came in as a charity. You pay yourself salary. You pay all this. They calculate how much is going to salaries. Then the rest is going to go back to your operations as a charity. Red Cross can't take that money and go and trade crypto and make $1 billion and say, because we're a charity, we're not going to pay tax on that 1 billion. No, that's the business expense they did, or sorry, business transaction. IRS will tax them, even though they have a charitable license.
Thank you very much. That's all.
You're welcome. Yeah, Simon, can you speak now, Simon?
Yeah. Hi, can you hear me now?
I can hear you, yes, Simon. Hi, how you doing?
Yeah, good evening, sir. How are you doing?
Fine. I want you to clarify something for me. Just if you can do the PIT.
Yeah, that's exactly why I called in. That's exactly why I called in. So, I mean, what the law says, Section 28 of the Nigerian Tax Act says that for individuals, so if you run a business, then you'll be taxed on the accessible profits of that business. So for you as an individual, if you have maybe a sole proprietorship, or you have an enterprise, then your tax will not be on your revenue. Rather, it will be on the accessible profit, which is basically the profit. Let's just call it profit. I mean, based on tax computation. So it will be based on the profit. So your 800K will not be on your turnover. It's going to be 800K of the profit you make for that particular period.
No, if you are the individual and the only income you make is coming from a business, what kind of business? Let's say I'm a sole prop and I'm a limited. What's the difference?
So let me use an example I used for someone the other day. I said, if I'm a chemist, right? I have a chemist shop. So what I'm going to do is basically I know that I buy and I sell. So at the end of the period, I'm going to remove all of the purchases that I've made. I'm going to remove the rent that I paid for that place.
Is the chemist private, or because that's really the main issue? Is it a limited liability company or?
No, not a limited liability company. It's a sole proprietorship. It's an enterprise, whichever one you call it, right? Even if it's a partnership, but it's not a limited liability company. So if it is not a limited liability company, then your assessment will be based on the profits of that business that you run. And that's why I mentioned Section 28 of the Nigerian Tax Act. It says it has to be on the accessible profits, which is basically also defined around Section 22 or so, I think it's about Chapter 2, Part 5 of the Act. So that place actually says, yes, your profit, your tax has to be on the profit as an individual. So it's not on the income.
That's what. So Section 58 of the Act.
No, 28.
No, but I'm reading Section 58. Section 58. The tax exempt status threshold is 800,000 for the individual.
Yes. So we need to be able to separate. If you notice, Section 28, which introduces basically the individual tax, right? It mentions income from profession, vocation, and then your business, right? So if you are working, if you are a worker, if you are employed somewhere and you make income, then you don't have any expense to deduct.
Look at where I say the commission is going on, right?
Yeah.
If a person owns an enterprise 100%, what I think is going on are people are saying that that enterprise is them. So they are basically saying that that enterprise, when they deduct the generator, they deducted income for themselves. That's where I see the confusion. The law is very, very clear. Section 58, individuals, the rates for tax for individuals is very clear on deductions and who is going to be taxed. Because what it expects is that that individual is paying himself a salary. You can't say you own the enterprise. That's why you register an enterprise in the first place, to separate yourself from the enterprise. So if I own that chemist you're talking about, I'm not the chemist, even though it's an enterprise. The chemist is buying goods, 100 naira. Is he going to pay tax on 100 naira? No. The chemist will buy goods for 100 naira and then pay the cost of the goods and have 20. But I'm not the chemist. What is my income from the chemist? That's the question. What's my income from the chemist?
Yeah, many times what we say is that as a chemist person, right, you most likely will not be paying yourself any salary.
Why not? That's the problem. And that's the confusion that is happening, that this tax law is going to change, because most times people just dip their hands into the sales proceeds and live their life. There's no drawings. There's no withholding. So what you are saying and what the gentleman was arguing about was the same thing Nigerians are doing. They own a chemist. Then they they want to buy food. They put their hand in the sales sheet and buy food. So we have gotten this idea that the chemist is my income. So when the gentleman asks me, will I pay tax? I have to back out everything. What are you backing out? You are supposed to pay yourself drawings, withdrawals, or salary from the chemist. You are not the chemist. The reason why you incorporated a chemist is to separate yourself from the chemist.
So, Kalu, I hear you. And this is not anything new in the Tax Act, right? This has always been there. That if you run a business, whether it's a small business, as far as it is not a limited liability company, whether it's a partnership, what you do is that at the end of the period, you do an assessment and determine what your profit is. If you have already paid yourself salary, you're also going to tax that salary. Perfect. The profit that you make for that period is now going to be subjected to the personal income tax. So you're basically.
But we're fine with that explanation. What we're asking is, when you pay yourself a salary, who do you pay the salary to?
Yeah. So if you pay yourself salary, you're going to do your 800K. You're going to do your 800K, right?
That's what we're saying.
Yes, but I'm saying that on the profit of this company, you also have to do the same analysis.
I'm not debating that. Look at what I think the problem is, Simon. And again, this is the problem in Nigeria. We're not yet used to this tax thing. Many Nigerians have got businesses, even if it is limited, even if it is PLC, that they simply dip their hand into the cash and fund themselves. They want to travel to Rome. How much do I get there for cash? We get 20K, bring it. They take that cash, and to them is their business. What the tax is clearly stating is that the business, let's use this example. They said the woman is selling akara on the road. Is she buying akara under her name or the name of the business?
So an akara seller, right, will do her akara business, right? Many of them don't even register as a business. Like they don't even register.
He said she was registered with a sole prop. So is she buying the akara in her name or the name of the sole prop?
I mean, many times you may not be able to distinguish. Of course, from an accounting point of view, you say, okay, it's buying it as a sole prop, right?
Yeah.
But I'm saying, yes, when you do that as a sole prop, any profit you make as a sole prop will now be also considered as though it's an income of an individual and then assessed to tax as though it is an individual.
But the question I then asked, and to be very, very clear, does the woman pay herself a salary or not?
No, it doesn't matter whether she pays herself salary or not. It's not relevant, because the way the tax will work is that if you paid yourself salary and then there is a profit, they are going to aggregate both of them and then tax you.
Is she taxed? Is she being taxed as an individual or as what's she being taxed as an individual?
As an individual.
As an individual.
Yes, but this time around, it will be based on the profit of your sole prop.
Now you're confusing me. This is where the problem is. If you are taxing her as an individual,
yes,
then she's going to pay 800K.
If you're taxing her as an individual, what you're going to do is that you are going to assess the profit of the company plus any salary she had paid herself. Those two will come together, and then you assess and remove the 800K, and then the other.
So you're agreeing with me. So it's the 800K, not 50 million as an individual.
Exactly. No.
So what are we debating?
100 million doesn't apply to individuals.
But that's what we're. Let me see if I can add him back. Maybe so he don't think I'm telling him. That's the point I am making. You are still going to charge her 800,000 naira. She can only reduce her allowables with the table here, the RSA, blah, blah, blah.
Correct. The top five.
I tried to add him back here. I don't know if he's here. I don't know if he's here.
Yeah, I'm listening.
So I added it. So Simon is there. You can ask Simon. He's a tax guy, I think. So ask him.
No, Kalu, the thing is very clear. What Simon is saying is what I am saying. Say the issue of separating the woman from the business is just a concept. It's an accounting concept that, okay, for the sake of liability's sake, this woman is not separated from this business because it is a sole proprietor. But for a limited liability, the company is an individual on its own. That is concept. That's accounting concept. But when it comes to these tax issues, after you still prepare your account as if you are a limited liability, but you get to accessible profit and do PIT, not CIT. CIT for limited liability.
So hold on. So you agree that the woman will pay under 800,000. Should be assessed. What was the argument for? What was the argument for?
Okay, no, you are saying there's a threshold of 800. So I'm saying no. The threshold, the 800 threshold does not matter for a business name, provided she's starting the business with social amount. She will deduct all her expenses. There's some other expenses that she won't deduct that the tax authority will add back. Like that man that is traveling around. The tax authority will look at it and decide to even add it back. But what I'm saying is this: for a business name, a sole proprietorship, once you get to your accessible profits, we will now do PIT. First 800, 0. The next
I'm struggling to understand what we're having an argument for. I was clear. You were saying business name, and I said 800,000. You said no. They're going to charge her expense, and I said no, 800,000. Once you say personal, 800,000. We went over this many times. So what was your argument? Were you saying that it was 800 from the initial start? Is that what was your argument?
I think we appeared both of you. I think it appeared both of you didn't agree as to whether the 800,000 will be on the income or will it be on profits. So
income or
what
profit?
The law requires is that the 800,000 has to be after the profit had been determined.
Section 58 of the Act introduced a tax. No, I'm not. Supreme. I'm not.
Yes, sir.
I'm learning. Supreme. The point when you ask, my name is Kalu. When you asked, I said she's going to be charged under 800. You said no, she's not going to be charged under 800. Then you're coming back and saying So
let me explain it to you. For those earning salaries that don't do businesses, what they are doing is their own is okay. The total money you've earned for this year as your salary is less than 800,000. You will not pay tax for those earning salaries. Like for those working in the banks and anywhere they work. Once the total salary for the year, your total pay for the year is less than 800, there's no tax. That's one part. For those doing business, now have the business in two places. Business as a sole proprietor and business as a limited liability. Now, For business as a sole proprietor and a limited liability, they have one thing in common. The two companies will prepare their accounts up to their taxable profits. You understand? So at that point, the sole proprietorship will calculate its tax based on PIT, while the limited liability will calculate its tax based on CIT. That is the difference.
But there is no difference. That's what we said from the very beginning. We said the Akaruma will sell at 800,000. You said no. We said the Akaruma. You said no. She will not pay 800,000. She will pay. And I stopped and I said no. You said personal. So 800K. I listed out this chart sheet here. You said no. You are saying no. She will not be charged under this.
What I'm telling you is this. You are saying there's nothing like expenses for that room. I said no.
Oh.
She has to take up all her expenses.
Oh, okay. So I get what you are saying now. So you are saying that she will take out the expenses, then will be charged the 800. Correct? That's what take up all the expenses before we charge the 800, but it will still be under the 800 table, right? That's what we are right now. Right. And if it's for the limited liability company, it will be 50 million or whatever, and they will still take out their expenses. Are we agreed?
For the 50 million, they also do their expenses and calculate their tax based on CIT for limited liability.
But for the Akara seller, she will take her expenses out and be calculated based on 800,000.
CIT, right?
Okay.
Yeah, personal income tax.
So are we good now? We're good now?
Yeah, we are good now.
Perfect.
We are good now.
Let's get Abu Usman.
Good evening, sir.
How you doing?
I'm fine. So my own question is this. For instance, now, if I withdraw, I invested in crypto, then I now withdraw like $500.
Crypto people.
Will that $500 be automatically be taxed?
Yes. Now, is it income? It depends. How much did you buy the crypto? How much?
When for instance, I bought it like with $200, then.
No. That's what you have to learn now in 2026. You're going to pay capital gains tax per purchase. So let's say you bought one crypto, then you bought 2 crypto, then 5 crypto, then 10 crypto, right? When you sell, you have to specify which one you are selling, just like stocks. Which one are you selling? Because if you sell the one you bought just today, you make less capital gains, right? Because you bought it today, you sold it tomorrow. But the one you bought 10 years ago, that one has gained a lot of value, you see? So if you don't specify the one and you sell, if they sell the one you bought 10 years ago, they're going to pay a lot of tax on that one. In America, you pay less tax. If you hold it for longer than 1 year, you pay lower tax than if you sell it for less than 1 year. So I think you have to specify which crypto you are selling. If you just bought one and you sold one, very simple answer. What's your capital gains tax? They will charge you. If it's not up to 150 or 10 million, you go to sleep. But if you buy that crypto and you sold it and it's more than that 150 or 10 million criteria, then you're going to pay. But I hear you saying 5 crypto. 5 crypto is not up to 10 million, Abi, and it's not up to 150 million. So you are safe.
Okay, that means if it's like $500, you just withdraw $500.
$500. Is it up to 10 million? It's not, Nabi. It's not.
No, it's not. It's like.
So yeah, you should be good now.
Okay. Then this other one, for me, as for an example now, I'm into manufacturing of furniture. Yeah. So, as we are working, as we get our job, that is when we start working on the job. Yeah. Then by so doing, we will also be running our expenses, like our home expenses and the store expenses from that job. Sometimes, for instance, this month now, I just got like 2 jobs making of sofa. Yeah. Just the 2 jobs. I started, I collected just like 500,000. Then after buying the raw material to finish the job at around 350,000 to 400. So, and also, I'm also eating from the money to run my own expenses and that of the store expenses.
Yeah.
So, will I be taxed among all these?
Yes,
Because
now you'll be taxed.
The money is not even enough for me to.
So my brother, I get your question. What I just advise you to sort of separate your accounts. We've just had a long debate now about PIT, personal income tax, and corporate income tax. What I would advise you to separate your whole business. Don't mix your personal and your business, because that's going to be where they'll catch you, right? If you are doing business, have an account for that. If it's separate bank, have separate bank or separate account for your business. Don't commingle. Don't go to your account and take money and buy gala. Don't transfer money from your sister to your brother through your bank business account. Separate both of them, because you can claim the costs of the making that sofa as an expense, right? And then you don't pay the personal income tax. But if you commingle everything, it's hard for you to. That's why I said yesterday, even if you don't have if you don't have the money to open a business account, a corporate account, at least have 2 business accounts, at least. So at least you can argue and say, this is where I do my transactions and this is where I do my personal account. Just have separate. It's best to have a company account with a company name and then your personal account. So you can pay yourself a salary, and that salary becomes even an expendable expense on your business. But if you don't have that power, to at least have 2 bank accounts and don't commingle. Yeah.
Okay.
Yeah, that would help you a lot. You want to avoid audit. You want to avoid them coming after you. They're not going to come after you. They're not going to, but try to keep your books in order. So talk to an accounting guy, they'll help you. Talk to a student, they'll help you. So don't make it too difficult, right? That works?
Okay.
Perfect. Yeah.
Thanks.
You're welcome. Mr. Frank has spoken. Tooth Fairy, hey, how you doing? Got about 30 more minutes.
Kalu.
Hey, how you doing now?
I'm fine. Good evening.
Good evening to you.
Good evening over here. So, thank you so much for this space. You've been talking for hours. It's not easy.
I don't know. Yeah,
well done.
My voice is gone.
So, the first question I have, and it's towards charity. Although many people have asked some question, but it hasn't gotten to where I want. So, for instance, I have this group where we're a small organization. We just, not really organization, we're just a group, really. And sometimes we do charitable donations. So we have an account for that. So I need to know what is ideal. Do we need to open a business account or just run it on a normal personal account? And because you said everyone is going to file their taxes. So how do we make sure that these things are spelled out correctly to everyone? Everyone is aware. I just need clarification.
Yeah. Are you talking about the charity itself now? The charity itself?
Sir, can you say that again?
Are you asking about the charity you are contributing money to, like how you can incorporate? Is that what you're asking about, the charity?
Yes.
Okay,
yes,
so
yes.
on the personal level, there's a charity. I have my own personal charity. There are other folks that have charities. If you go to CAC or you just talk to a CAC lawyer, the most common one is called incorporated trustees. You incorporate it, you have trustees, you put them as incorporated trustees. So that's vehicle is tax exempt. So any monies you receive into that vehicle is anyone that gives you money can say, I give to a registered charity, and they can back it off their income. So if you guys have that, you're already doing charity, think about incorporating that trustee. Then when you make a donation to that trustee, you can then on your tax return, you can say, I made a donation that's going to be backed off your income, right?
Okay.
So make it legal, make it structured, and you can make your contributions, and then from there, that charity can then do exactly what you guys are doing. Now, the charity will, of course, have to file taxes at the end of the year and say, this is our operation, because they want to avoid this instance where you guys simply wash your money through the charity, whereby you give your charity money, then your charity is buying diesel for your house. That's not charity, right? So they want to avoid that. That's what the filing of the charities do. If you file, you're able to get that taken care of. What I'm not sure, I know what my tax people have gone. What I'm not sure is if you contribute to a charity, if you can get tax relief as an individual. I don't think you can. Maybe my tax guy can come back and let me know. If you contribute, let me go on Twitter. If you contribute as an individual to a charity, does the individual get tax relief? If you guys can answer on Twitter, guys are just wonderful. If you guys can just answer for me, please. That's the only answer I haven't given you. So if the answer is yes or no, that would help. But apart from that, what you want to set up, yeah.
Okay, so thank you very much. So my next question, although I listened to the last live session you had, and it was on about how if formerly employees didn't have to file their taxes themselves, but the example you used is an bank worker. But what about core government staffs that already have these deductibles, the pension? Are they still going to have to file their tax? I know you don't have the full list of deductibles that you've listed out currently.
Well, the full list is here. I have the full list here. If you're on YouTube, you see my full list on. I'm showing the screen. So
yes,
yeah. So what I'm saying is right. See, yeah. What I think they are going to is the American style, where you have to file your own taxes individually and not wait for your company. The reason why most companies file taxes is because in the past, payroll tax was where we paid payee. Payee is what states get. So for instance, Lagos State gets money from payee, which is a payroll tax. Then the law says whatever your payroll is, you get 20% automatic deduction. So your company is very easy for them. If they pay you 12 million, let's just example, they pay you 12 million and your payroll has 12 million, they just hit that payroll with 20% tax relief. That's what you get for your personal income tax. Then they file the other taxes for you. End of story. With the RSA and the rest, end of story. Now, what they are saying is that they've removed that 20% automatic deduction. It's gone. It's no longer automatic. The deductions remain, but it's no longer automatic. So you have to go and then do your RSA, do your NHF, and all that life insurance. So I asked my guest when he was here. He's an MD. How do you guys do it in your company? He said that companies have to, that the individual has to tell the HR that, hey, I bought life insurance, so mark it off. I don't think that's going to be possible for a large company. If you have a company where you have 5 employees, that's fantastic. 5 of them can tell you at the end of the year, hey, I bought life insurance. Hey, I did this. But what if you're like a Zenith Bank? That's what we use Zenith Bank. What if you're Zenith Bank or UBA or even Dangote? Dangote has nearly 500,000 workers. How will they operate? Unless they're going to do a portal. And the portal will say, okay, if you bought life insurance, put it here. If you bought this, put it here. Maybe that's what they will do. But you've got to communicate back to the company, or the person doing your taxes has got to know that you've bought life insurance or that you've done additional voluntary contribution. Otherwise, you get hit with the tax. So the point I'm making is that if you don't communicate that purchase to the tax authorities, they will tax you. That's the point that's going to change. So you can still file with your company, but your company has got to have a way to receive information from you that you've done those deductibles and then take it back to the Nigerian Revenue Service. That's the difference in this instance now.
All right. Thank you very much.
So ask your organization how they are going to do it. If they say, oh, we got you, just let us know by this time and we'll file. That's good. If they say we're not sure, then make sure you go and file on your own. Yesterday, there was a lady here yesterday that showed us her Lagos Inland Revenue tax filing. She said the company takes her payee. She also files her pension and the rest to the same Lagos State Inland Revenue Service to get that deduction. So if you don't file the deduction, you don't get it now. Remember, you don't get it now. They've removed 20% payroll automatic. It's gone. So if you don't file it, you will not get deduction. That's the point I want people to take away. Make sense?
All right. Thank you very much.
Yeah.
Yes, it does. It
All
does.
right.
And one last question, just the final one. I know it might sound like a dumb question, but I just want to be sure. So after you get your salary, you do the necessary deductibles, and you obviously would pay whatever bracket you fall in the tax table, you pay your personal income tax. Then the rest of the money in your account, you're free to do with it as you will. You can choose to do the whatever saving method,
No,
20, 10%.
say it again, please. Say it again. Just say it again.
I'm saying after you earn your salary, you earn an income, yes. Then you do the necessary deductibles that have been listed and provided in the new tax law.
Yep.
And obviously, whatever is left over will be taxed or not taxed, depending on what the money that is left falls under, yes. So I'm saying that once that is over, you get tax or you don't get tax. The money that you have left, you're free to do with it whatever you're free to take out your expenses, do your discretionary, do your emergency fund, do your investment with the rest of the money, right?
Yeah, correct. Yeah. Once the whole idea is that the income is yours. So if you want to reduce your taxable income, you buy your deductibles. That's just it, really. The income is yours. So if you want to reduce your taxable income, we do your deductibles. That's basically, if you want, you can decide not to pay taxes. You can say, I earn 2 million. I'll spend my money and I'll pay the 15% on the excess above 800,000. You can do that as well. You can say, I'm just going to spend the money and pay the government 15%. You can do that as well. But if you want to reduce your taxable income, what we need to understand in Nigeria is what is called total income, then taxable income. This whole idea, this whole space we're having is to show you how to reduce your total income to get a lower taxable income. What we're interested in is your taxable income, not the total, because the total is going to be exposed to taxation. So if you're a company, it's easier. You have a lot of expenses. For an individual, you have just those 5 or 6 to deduct. Yeah. Make sense too?
Okay. Thank you. Yes, that's very clear. Thank you so much.
Perfect. Let me get Chidiogo. Hello, baby. Thank you for you. Chidiogo, hi.
Hello.
Hi, how you doing? Good evening. Hi.
Hear me?
Yes, I can, ma'am. I can hear you.
I'm fine, thank you. So I wanted to ask about DVAs, like dedicated virtual accounts. For businesses that use some of these fintech platforms, and DVAs are automatically created for their customers to pay in money. So I wanted to ask, because I have something like that. So I wanted to ask, funds in dedicated virtual accounts, are they taxed? Like, how will they be taxed? Because I noticed that the creation is quite automatic. So I'm not sure.
So I hear you. I didn't
hear you.
No, I hear you. I'm saying that.
Okay, so I'm not sure if BDN is used to create those accounts.
It doesn't
matter. So I wanted
matter.
to know how to be taxed.
It doesn't matter what you have in the name or the account or whatever you have. What they're taxing is your income. So if you have it in an RSA, if you have it in a, let me be clear. If you receive income, it's taxable in whatever form it's at. Once it's income, it's taxable. So whether it's you got income into your digital virtual account, you got income through your crypto account, you got income through your stockbroker, you got income through commissions, you were a YouTube guy, YouTube paid you, you got your boyfriend gave you 2 million naira because you helped him decorate his parlor. Any income you get is taxable. Any. Now, the question is now going to be, how do you reduce that taxable income? That's basically it. So no matter the name it comes, if it's income, it's taxable. They've tried to address any loophole in this new tax law. They even crypto, they listed everything. If you stake and your income is, if you get what's it called, airdrop, it's income. Anything is income according to the tax law. Yeah. So yeah. Does that clarify it?
All right, that's fine. Thank you.
Yeah. So once you get it, your next. So that means every month calculate your income. Calculate your income and then say, how am I going to reduce my taxable income? So like what I do, if you can have an Excel sheet, right? You can put your total income. You got your active income, the one you got, your salary, blah, blah, you put your active income. Number 2, you put all those other things you're talking about, the money from crypto, money from your landlord, the money from the shop you own, all those income, put it together. Now you ask yourself just roughly, put it on that table, because they'll give you the table. And there's a table from the tax guy himself. Put it on a table. You see your tax right there. You see how much you are owing. So what I'm saying, walk to the answer. If you put your total income on the tax table, it will tell you your total tax that you're going to pay. So if you're going to pay total tax of 1 million, then you know, okay, I have to invest 1 million. Then you go back and you buy RSC, maybe 500,000. Then you buy insurance, maybe 200,000. Then you buy NHN, maybe 100,000. You see what I'm saying? You can put your income on the table, get your total tax liability, then walk back to the answer. You can say, man, I don't have money to invest in RSC. I'll just pay the tax. You can do that as well. But you can walk to the answer, walk back, put your income, get your tax liability, then take that tax liability as what I have to invest this year. So what you want to do, like, what if you earn 50 million naira per annum in Nigeria, go to the tax table, plug it in the tax table to tell you your total tax. Let's say give you your total tax is 16 million. You now know that if you invest 16 million in those 5 things, you will not pay tax. That's how you want to work it. Back to the answer. Chico, make sense?
Oh, wow. I mean, it's so clear. Thank you.
You're welcome.
So
Yep.
great.
Cool.
Thank you.
Work with that. Yep, gotcha.
Yeah.
Emo Prince. What's up, Emo Prince?
I'm fine, thank you. Good evening, Mr. Kalu.
How you doing? Guys, let me see how long I have. About 30 minutes, I've got to go. 30 minutes, I've got to go. Hey, go ahead, Emo Prince.
Okay, it's always lovely coming to your space because if I stay here long enough, then all the questions I have jotted down get answered.
Yeah.
Right? So, I have 3 things I want to ask. 2 are clarifications, then 1 is a major question. So
Okay.
I'm going to start from the clarifications.
Okay.
Earlier in the discussion, we talked about investing something like $1 billion. And say it's coming back, that's investing 1 billion in sovereignty, right? One of the FG bonds or treasuries.
Yeah.
And let's say you get a 20% interest, right?
Uh-huh.
That's about 200 million.
Uh-huh.
Now, if that 200 million out, based on our guest speaker before he left, he said the 200 million will be taxed, right? What if I invest that 200 million?
He didn't say it would be taxed, though. He didn't say it would be taxed. What he was saying was that if you take that money and you invest in the treasury bill, the sovereign treasury bill, treasury bonds, savings bonds on sovereigns, you will not be taxed. You will not be taxed.
Even if the interest of 20% comes back?
Correct. You will not be taxed. What he was saying is that your income, your own personal income will be taxed because, you are earning more than 800,000. You invested $1 billion, Abi. Yeah. So you pay the tax. You pay the tax. Now you can't say you invested 800 billion, but you are earning 10 naira. So what he's trying to say that you will not pay tax on your investment in Nigerian sovereign, but on the personal income side, because you now have the means to invest $1 billion, you then be taxed unless you take those deductions. Yeah.
Okay, thank you. Second one, if say from the project I get 50 million naira, although this basically answers itself, right? And then I take 49.7 and push into those 5 things you mentioned. That means I'm tax exempt.
Yeah, you reduce your you reduce your taxable income. So you remember, if you go on YouTube, right? I did a YouTube thing where I just maxed out all those deductions, and I took a guy from 50 million to nearly nothing he's going to pay in taxes. So many guys were saying you can't do that in real life. You can't max out the expenses. I don't see anywhere in law that says you can't max it out. But the point I'm trying to make is that, yes, it's possible to reduce your taxable income to nearly zero. If you take your money, like I told Chico when she called, what you want to walk to the answer, put your total income, go to the tax table. There's a tax table that's issued by the tax team that has the new tax tables. Go to that new tax table, put in your total income, both active, both dividends, both shares, both everything, put it there. It will calculate your taxes for you to tell you if this is the income you're going to make in 2026, this is what you're going to pay in 2027. It will tell you. Then you pick that figure, then you go back and say, okay, I have to invest 10 million. So 10 million, I'm going to put 5 million in RSA. 5 million divided by 12 is 600,000. So every month, I'm going to do additional contribution of 600,000 every month. That's what they're going to do. I want to do 100K in life insurance. So every month, 100 divided by 12, I'm going to do life insurance. I'm going to do NHF. I'm going to do premium. I'm going to pay for myself and my wife. I want to do 1 million premium. So you walk back and you say, okay, my bill is 15 million. I'm going to walk back and contribute that to my IRA. So if you do it that way, when you then file taxes, you have no tax to pay because you've reduced your taxable income to zero. You are earning income, but the government has said if you buy RSA, voluntary contribution, if you buy life insurance, if you buy this, you don't pay us tax. It's the same thing I do. The same Americans do. Americans would do Roth IRA. to reduce their taxes. They'll buy this or buy that. Same thing you are doing here.
Okay. Thank you. That also clears that out. So now for the major question, and
there's a major question.
Yes, when someone mentioned crypto earlier, I heard you under your breath say this crypto guys, but we're back on your space, right? So I'm in the crypto space more on the P2P side, right? On a monthly basis, we do, let's say, between 50K to 100K dollars. So let's say 150 million. If we multiply that through 12 months, we're close to 2 billion, right? But most times the profit spread is less than 1%. So if we're looking at 2 billion, 1% spread is roughly 20 million, right? And sometimes we don't make up to that. Sometimes you do. So what then happens? Because I know in the previous conversation, there was an and, meaning you have to cross a threshold and you have to make a profit, right? Now, would you advise, so that's one of the questions. It's like two parts. The second one is, would you advise that we do this on an LLC, considering that banks will still take their COT or sometimes 1 naira or 20 kobo or 30 kobo, depending on your AO? Would you advise we move it to the LLC and do it there? Because then we can, say we use this for this and deduct it, or we do it on the business name. So the two parts of the question.
It's not a simple yes or no. There are many things that determine if you want to incorporate. But even apart from taxes, if you are doing that kind of volume, it's preferable under a business name, just for the incorporation and the liability. So just without taxes, just on a business level, they are making that kind of transaction on a corporate name, just to give you that limited liability, right? So then the law, that's the first hurdle. The law then says you have to pass those two things. Number one, you have to pass 10 million. Number two, you got to pass 150 million. Both have to happen, right? So once one happens, you are now liable to pay that capital gains tax, and then you just have to pay it. So you see, what's going to happen in Nigeria is exactly what the Americans do, where before they sell, they look at the tax consequence for they sell. Nigerians haven't done that in the past before. So now you're going to see people saying, no, I want to take long-term gain. We've not brought that into Nigeria yet. They just say capital gains tax. In America, they have long-term capital gains, short-term capital gains. If you notice, Mr. Warren Buffett does not sell short stocks. It's not because he's doing buy to hold. It's because if he sells, he's going to pay tax. So you see him saying he pays less tax than his secretary. That's because he does earn income. He doesn't pay tax on securities that he holds for more than 1 year. Eventually, we're going to go there in Nigeria. We're going to say, okay, if you buy the stock and you hold it, you're going to get a lower tax. That's what we'll have to do, because otherwise, people will keep trading. There's no incentive not to trade. If I'm just going to pay tax on the trade, okay, I might do the sale and not take any money out. I'll pay the capital gains, but not the realized profits on my CIT. So there are a lot of calculations there. It's not just to say, should I or should I not? I can make a loss on crypto and then use that loss to write off my profit on crypto. I can do that right now, the Nigerian Tax Act. If I'm making profit, I bought Bitcoin's going up. I can go to my Shiba Inu crypto, sell it at a loss, take the loss and pay off the crypto profit, things like that. That's what your tax expert is going to tell you and advise you what to do. So people are going to build apps, are going to build those sort of apps in Nigeria that will tell you, if you do this transaction, this is your potential tax liability. Then you'll be like, okay, should I or should I not? Making a loss sometimes is making a gain. If you make a loss and you can use that loss to file and reduce your tax profit, that's a gain. So, but this is as good as going into advisory that you want to talk to a tax professional about.
Okay. Thank you very much. Then the last one, which I'm sure will be
you still
pretty
have more
short.
questions? Okay, it's last
Just one last one. So I watch a lot of movies, right? And then occasionally I see this thing where some people buy shares and borrow against the shares because loans are not taxable. Do you think that still applies in our sector?
No, that's called shorting. That's called shorting a share. Where what they do is that if I have shares if I have shares in a company in Nigeria, I can tell the company to lend out my shares, and they will pay me interest on the shares I've lent out. So if you're a short seller, you go to that company, you borrow my shares. You borrow my shares, you sell my shares. The idea that the shares price goes down, you buy it back and give it back to me at a profit. So you made a profit, right? But Nigerians, we don't do that stuff in Nigeria. Nobody's going to give you a share to borrow or buy. So we have the law that says we can do short selling, but we don't do short selling in Nigeria. We don't have it. So there's no secondary market. There's no market where you can go to and borrow 1 million shares of Dangote and short it, then to buy it back and give back to Dangote. We don't have that. So it's just there in law, but we don't have that here.
All right, thank you very much.
You're welcome.
Thank you.
Yeah, let's get Iwaha Eugene Chibus. How you doing, Iwaha?
Good evening, Mr. Kalu.
Hey, how you doing, sir?
I've been waiting for some time to talk.
Sorry,
thank God it's not my.
We have to call today. Just yeah.
Yeah. So now I'm talking about people cooperative. Now they have people coming together and have a general one particular account. So, but the business they do, they all channel it into the account. And then in the account book of the cooperative, they receive those money from the different businesses as a liability. So how will this affect the taxing of the cooperative?
I don't understand your question. No. I know where you're going to, but I'm not asking it well. So the cooperative is a company, so it has to basically separate its accounts. There's no commingling. If you commingle, you are exposing yourself to taxation. So if you have a cooperative, people are paying you money. That's going to be your deposits. That's liability. But that deposit is earning you interest in the bank. You're going to pay tax on that because you're a cooperative. If you have turnover above 50 million, they're going to be assessed for taxation.
How will it affect the depositors?
That's not your business. No. I don't think that's your it's like you paying Dangote for cement. So how does it affect Dangote when you pay Dangote for cement?
Taking myself as the chairman of the cooperative.
Okay.
And now these are members of the cooperative. So the law of the cooperative is that the business you are doing, all your business transactions has to pass through the account of the cooperative.
Okay. What do you mean by that? The cooperative business is say it. I don't understand what that means.
We are farmers. So, but in this cooperative are different farmers. This one's maize. This one produces, processes the maize. This one, just like that.
Okay.
So, but now the rule is that all of us in that cooperative, all the transactions that we'll be doing will be passing through the cooperative account. So, if you need money, you withdraw from the cooperative account. So it's run like sort of a mini non-bank microfinance institution, sort of like that.
You see the problem? This is what I was going to with you. You guys are doing a lot with that account. You're in a financial institution. You're in a cooperative. That's why your questions are kind of jointed. If you are lending money, taking deposits, that's a different animal entirely than if you're a cooperative. A cooperative is a very, very simple organization. People come together, contribute, you buy stuff, you distribute, they pay. The more you complicate that account, the more you are complicating your taxes they're going to pay. Because the tax guy is going to come to that account and say, what's going on here? You are making a contribution, you are lending out money, you are charging that person interest. What's going on here? And they'll start to hit you with many exceptions and clarifications. You got to clean that up, guys. Just clean it up. If you're going to do a loan, have a separate thing for that loan. If you're going to receive contributions, have something separate on its own incorporation. So I would advise you go speak to a lawyer and an accountant and get how you can restructure that whole thing to prepare for this coming tax thingies. Because I think I understand what you are doing, but if you take that into 2026, you're going to expose yourself to unintended liabilities from the tax guy.
So now we're talking about turnover on the business or whatever. Now the issue where I'm driving to is that whatever money that these members of the cooperative are contributing in this cooperative account is not regarded as a revenue, right?
No, that's the point I'm making, sir. You have it all over the place. You just said, is it a contribution? Is it an investment? Is it a donation? What is it?
Is a contribution. Is a contribution.
To what?
A cooperative. What are you doing with contribution?
So I can't give you tax advice. I tell you what, go try to speak to an accountant and a lawyer and on not what you guys are doing. Corporations have their own law. The tax law is also very, very clear. If you're not a company, right? Is a corporation registered as a company or as a corporation? They are very, very clear. That corporation, like a charity or whatever it is, you have to take inflow, your depositors' monies. What business are you doing? You have to back out the expenses. Are you making a profit or a loss? Is that what you guys do? Do you do income, deduction, net profit? Who takes the profit? Is it by all the contributors?
Yes, so from the contribution that members are making, from there too, members can also ask for loan. Right, so if the income we make is from the loans members.
What's your question?
So my question is this: now, these members of this cooperative that are making these contributions in this cooperative accounts, is there any tax implication on them based on the contribution they are making in these cooperative?
Contribution, it's not a tax event. You are taxed on income. So what's the question? Again, I ask again. If you are making a contribution, you're not earning income. So what's the tax question there?
Now, because where I'm looking at is this: these people, these members of the cooperative, at the end of the day, based on the law, we have to look at what we have contributed and share it back amongst ourselves at the end of the day.
So I don't want to keep on. So see, you pay income tax on income. What income are you referring to?
The income in this cooperative is
good.
Generally
But contribution is not income. So what are we talking about?
I'm just looking at how it's going to affect the people that are making contributions. What is the law talking about?
But contributions is not income. The tax is on income. You are talking about contribution. There is no tax. Contribution is not a tax event. If I donate money to you, I don't have a tax event. I gave you money, Abi. You have received income. You will pay income tax. So if it's a cooperative, if I donate to a corporation, I've already paid taxes now. So how does that worry me? If I got ₦1 million and I paid personal income tax, and I take my post-tax contribution I create to your cooperative, then you have to worry about the taxes. I have no business with.
No, Mr. Kalu, I'm missing this.
We got to move on. We got to move on. Send me a DM. Let's get Cashry HQ. Let's get Cashry HQ. Cashry HQ, guys. We got to go 15 minutes and then we're gone. Sorry about that. I've been here for a while. Cashry HQ, guys. Put some names I can read. Cashwire.
Yeah.
All right, man. What's happening?
Yeah. Thank you for this session. Very informative.
All right.
So, straight to the question. What happens to fintech companies or crypto companies rendering crypto services to retail, to customers? How would the tax be factored into transactions? How would it work?
What tax?
So say a customer just wants to sell his crypto assets. He has Bitcoin, he wants to convert to Naira and then transact or from.
Okay.
So would they be taxable? Would that such kind of transaction be taxable? Is it a taxable transaction?
What did he do?
He sold his Bitcoin. He had Bitcoin.
Well, how much did he buy it?
So let's assume he bought Bitcoin for let's say he bought 150 Naira worth of Bitcoin.
How much did he sell it?
And he's selling it at 170.
So he made 20 Naira profit.
Yes.
Okay. Usually that 20 Naira is called capital gains, but the law says you have to do 10 million profit or 150 turnover. So he has a capital gain, but he will not pay because he hasn't reached the threshold. Yeah?
Okay.
Make sense?
All right. Thank you.
So, Supreme, you're back. Did you have a clarification or?
Yes, let me clarify the guy that spoke before Cashwire. What they do with their NGO is that they are doing business with it.
That's why I was going to. That's what I was going to.
Because the trustees share profit at the end of the year, they will pay PIT for all of them.
Yeah, but where I was even going to Supreme is that they shouldn't even be doing that. That's why I didn't want to get into that conversation. They shouldn't even be doing that.
They are gaming the system.
Good. And that's why I told you to go and see an accountant. Yeah, I knew what he was saying, but I don't want to go and get into that. You can't use a cooperative to do business because then that's why his questions were not coming out too clearly. If you are receiving charitable contributions, you should not be doing a business and doing loans and all that. No. Obiora, how you doing? Obiora. All right, guys. Abba, Mr. Abba _ Atamils. Abba, real quick, so we're gonna round up. Abba is in there. Olushaya.
Yeah, thank you, Kalu.
How you doing, sir?
Good, thank you for asking.
About to go your last one. I gotta wait. Olushaya is speaking. Olushaya, go ahead.
All right, quick one, Kalu. I'd like to check with you for money market, like maybe you're getting like approximately 400,000 monthly.
Yeah.
From your investment, and maybe you're pulling it out into other things.
Yeah.
Are you required to pay taxes on those? Maybe approximately at the end of the year, you made maybe 4 to 5 million naira.
No, because you already pay tax when you get the interest, so that's kind of easier. When you put the money market, you got that interest. They taxed you already there.
Sounds good.
So when you roll it over, it's already pre-tax. So every time you roll over, they take their tax. Roll over, they get their tax and all that. Yeah.
Fantastic. Thank you so much. I appreciate it.
Abba, Obiora, hi.
Hello, Kalu.
Yeah, what's up?
Yeah, good evening. Just want to ask for someone that has equipment, construction equipment.
Yeah, go ahead. I can't hear him. So we're gonna do Abba, we'll do Obiora, we'll do Safim, and then we'll call today. Abba, I can't hear you. If you're speaking, I can't hear you. I'm so sorry. Are you still speaking? I can't hear him. Supreme, can you hear him? He's dropped off. Obiora, 1 year. Obiora, 1 year. Not still ready.
Hello.
Obiora, hi. How you doing?
I'm fine. How are you doing?
I'm doing fine. Doing very well. Thanks for asking. What's up?
Man, I'm getting more confused in all this explanation I'm getting you.
What's your question?
Huh?
What's the question?
Yeah. You said if a personal account that I will be that someone. Can you hear me?
Yes, but can you speak up and subcover? Okay, perfect. I can hear him. Saim Campbell, SAEM. Please go ahead, sir.
Am I audible, sir?
Yes, you are.
Yeah, good evening, Mr. Kalu. Supreme. I appreciate what you've been doing. I'm your really added follower. Let me not say fan, because I'm a big fan anyway. So I thank you. I appreciate everything you're doing.
Yes,
My
sir.
potent question is, are you saying somebody who earns, and I have two questions, somebody who earns 800K a year will pay 15% as a tax? According to the act, not you.
No. What they're saying is this. If you earn, ask your question again. What figure did you quote? What figure?
800K to 1 million a year.
If you earn, let's say you earn $1 million a year, right? You're only going to be taxed on 200,000 naira. So you can take that 200,000 naira and buy those deductions, and you are good. If you don't buy those deductions, you're going to pay tax on 200,000, which means the first time you pay tax, you're going to pay 15% on that 200,000. That's what the act says.
Okay, 15% on the 200,000, not on the 1 million.
Correct. Because the 800,000 is going to be 0%. Yeah, correct.
Fine. So my question now, my other question is, why do you why should Nigerians be taxed on that?
I don't want to go there. I didn't write the law. Don't ask me that. Just focus on. I'm just doing taxing.
Are you saying I shouldn't ask that?
Ask the government, not me. Ask the government. I'm just explaining what they've done.
Okay. Are you saying my question is not potent enough?
I'm saying that I'm not the one to answer that question. That's a government question.
Okay. I really appreciate that. Fine. And in the basis of crypto, because I'm crypto inclined, and are you saying we are going to pay tax on airdrops and bounty?
Yes.
Because when I saw that, I couldn't believe it.
Because it's an income now. It's an income.
It's income.
Gift. No, it's not a gift.
It's an income.
It's not a gift.
Income.
It's income.
Okay. And what basis is it an income?
Can you sell it? Can you sell it tomorrow at a profit?
Yes and no.
But yes, it's involved. If yes is involved, the taxman will tax you. You didn't pay for it. Okay. So someone gave you. So it's like Dangote gives you a gift. You don't pay tax on a gift. But this is they are giving you an airdrop that is an asset that's worth something. So because you are receiving that asset that is worth something, when you receive it, you don't pay tax. Remember, you don't receive it when you pay tax. They're not saying you pay tax when you get it. If you get the airdrop and you sell it tomorrow at a profit, you pay capital gains tax.
And I'm subjected to that outrageous tax.
Which outrageous tax is that? Right? Which one?
The percentage.
Which one?
15%.
Of capital gains tax? And I don't know, I'm not sure about the percent, but you pay capital gains tax if you sell at a profit. Yes, as a profit, correct.
Thank you very much. I really appreciate it.
You're welcome.
I'm following you on Facebook big time. Yeah.
Not a problem. All right, folks, we got a call today. Thank you so much. We spent nearly 5 hours or so 4 hours on this guy. So we got a call today. Thank you guys for hanging out there. So the next ones I'm going to do, the next stuff I'm going to do on the tax stuff is to show you in real terms how to bring down your taxable income. We want to learn that. That's why I'm doing this. I'm not for or against tax. You can't say no. That's not a strategy. You can't say I will not pay. That's not a strategy. It's now law. So if you don't pay, there's a charge on you. Can they change the law? Maybe, yes, but that's for you to go fight for it, right? But as it is now, in January, you're going to be hit with these taxes. And I know if you watched me today and yesterday, you have learned more on how you can restructure your behavior, your spending to be ready. There is going to be a change in January. It's going to be a massive change. If you do nothing, your tax is going to go up. 800 is just the starting. You still have got to go buy the investments to bring down your taxable income. So I'm going to try to do more on those deductions, those legal deductions. Those questions, can I not? You can ask Grok. It will give you more detailed information, right? Well, I want you to focus on what you can do. What you can do is to reduce your taxable expenses. You can't argue about the act anymore. It's already passed. So focus on bringing down your taxable deductions. And again, focus on holding the folks that are going to spend your money to account. You're going to pay a lot of taxes from 2026. Focus on your local government area and ask the guy, I'm paying you capital gains tax. What are you doing with this money? That's the whole idea. You can't pay tax and not see the results of this tax. So you've got to hold those guys to account. That's the two things I want to basically let you guys know as you're going forward. So thank you all for hanging out here. It's been a pleasure. I'll see you guys. We're going to record the space itself. Is going to be on the podcast. We're going to share that immediately now. YouTube as well. We're going to share it out as well once we end the space. And you can go back and hear the recordings. And again, just read it up. The access online. Ask Grok. Ask that they will help you to interpret this stuff. But it's a very, very basic thing. If you earn income, you are going to pay a tax. If you earn income as an individual, your deduction is 800,000. Once you're above 800,000, you've got to buy these deductions. If you buy these deductions, then you do not pay tax, or you reduce your taxable income. If you're a company, your threshold is 50 million turnover. If you do above that, then you're going to pay tax. So you want to talk to an accountant and say, how can I reduce my taxable income, both for the company and both for the individual? And you'll be fine. Don't worry too much about it, guys. It's going to be all good. All right, guys, on that note, let you guys go. Enjoy your day. It's going to be a wonderful Monday. I'll see you guys next week. Next week, we're bringing back not next week. Let me confirm if I tell you guys what we're going to do. Next week, I'll see you guys here Sunday, 7 p.m. West African time. Hang out with me again, right? Have a good one, and bye.